curve, or longer end of the curve, I should say. CPI report comes in a little bit weak today, but it does not do much. Fed cut odds for June and July continue to melt away as well. Gold, it bounces back a bit, but silver and copper, the two growthier names, they are up, which reflects that strong standing we have on the sector rotation today for equities, where it is all growth and growth across the board, through and through. You make your way into the world of commodities outside of metals. Oil is up as Trump is in Saudi Arabia talking about plans to invest in the U.S., $600 billion investment coming our way. And of course, in the world of currency, the dollar is down everywhere, which may throw some people for a loop, myself included. Ilya is going to talk about that. But Dylan, let's start with you first. 5,900 in the S&P. So where we were at the end of February, it's where we were basically at the start of the year. What have we learned in 2025 with stocks now unched year to date?
You'll fade the tariff, baby. Fade the tariff and fade Trump.
Fade Trump. Mm-hmm. Is that the lesson here? Why do you say fade Trump?
Because he likes to draw a lot of attention to a big, scary idea, and when you take it seriously, it affects the price of things. And he's just using the big, scary idea to create an attention generation machine that will last for months until every last deal gets done, but it has nothing to do with actually getting a deal done.
Ilya, it sounds like Dylan thinks we're back in the mindset of the market in January and February when it was the boy who cried wolf.
There's a lot of logic to that. I think it makes a lot of sense.
Can you explain why?
Well, we have a 90-day cliffhanger again. And what did we see? I think the GDP numbers for the first quarter were particularly instructive. What did they show us? Yes, it was a nominal contraction, but it wouldn't have been one. It would have been just a slowdown. And let's not get it confused. Growth slowed in the first quarter. There's no question. But it would not have been a negative number were you not to have had a massive surge in imports as people were front-running the tariffs. Now, mind you, this is happening before April, before Liberation Day. This is just, we're noodling around renegotiating the USMCA at some point into February. But this already becomes a dynamic in January because the markets, with the start of the new year, know that tariffs are coming because they know who's about to come into the White House. They heard what was said on the campaign. Obviously, there would be tariff hikes of some sort. And so there is a front running of that at a huge scale in the first quarter GDP numbers. Now we have a 90-day cliffhanger with China. So we have a window to continue to stockpile. What's going to happen? Another surge in imports, likely. Another huge outlay on inventory, likely. And then the real question becomes, and this is why the retail sales and the consumer confidence numbers are so key this week, does anybody buy that inventory? Is that inventory a bad investment?
Or how many days or months or years does it take to clear it, basically?
That's right.
Hopefully not years. But.
That's right. If you have a falling appetite for consumption, if consumers, as they did in February and March, look at all of these shenanigans more with a kind of attitude where they throw up their hands and go, this is really uncertain. We have no idea what's going on. It's all very fungible very quickly. It's all very volatile. We're just going to hold back here. And that's what you see in the University of Michigan consumer confidence numbers, in the Conference Board consumer confidence numbers. You see it from the business side in the PMI numbers, no matter which version of them you look at, S&P Global or ISM. It's all over the board in the numbers, that the volatility and the fungibility of policies creating uncertainty, and that's a dampening effect on consumption and on investment. And so when you set up another cliffhanger, you basically go, okay, well, we'll run the first quarter again. And then if consumption then doesn't pick up, because in the first quarter it was the weakest in almost 2 years, if it doesn't pick up, well, then you're left with basically businesses having made a bad investment by stocking all this inventory.
Once more, I think that we've learned, just like we did in Trump 1.0, that this isn't a trade war to remake the global order, to reshore manufacturing. It's a trade war to trade more, right?
Yes.
The United States wants Chinese consumers to buy more American crap. And Trump's worldview, American consumers have been buying enough Chinese crap for years. And we want to rebalance that out. We make some of this stuff and you guys purchase it now. And ultimately, hopefully, that means some jobs along the way.
That was the story, by the way, with the USMCA version of NAFTA. It ultimately was just a broader trade agreement. Really, the only difference between the USMCA and NAFTA is that it covers more stuff. So actually, you got more free trade out of it, not less.
More free trade out of it, not less. The market seems to be sniffing this out, that we are through the deep, dark woods of, will there be a harrowing recession that ultimately drives the global economy into a ditch from which it may not recover for years and years and years, because you enter that 1930s trade spiral. I can't help but think that oil is probably one of the better indicators that we have in this market right now, that we should be feeling a little bit more optimistic about stocks. 63.25 here. Dylan, you've been very clear about how the market was too bearish on oil, too bearish on this whole darn thing. It's up about $5 over the course of that mindset that you've been taking here. So what's now the play in oil? Is this thing still going to run?
I mean, I don't know. I mean, because I got in there a few days ago, as we know, we talked about this, and I do feel pleased with the moment, but I'm also too old and too tired at this point. I've been through too much to get too pleased, because I've seen what happens. But, anyway, the oil thing's working at the moment. And I don't know if I would get involved new. I have these, my relationship with oil is on like moments of fade, of divergence. I don't know, I have a daily opinion on this, and I'm not sure what you would do at this price point, but I do think that to the degree to which Trump gets discounted out of it, that the Trump policy-making apparatus is deemed to be disruptive, but not catastrophically disruptive, it's all both clears the way for robots in the world. AI super glide is ready to go here. I think it's the first word that wants to sneak in after Tariff leaves in the news cycle. And I think that and trade war to trade more, it means more global logistics plus more electricity. You can talk yourself into a crude position pretty quick. Just on electricity and logistics.
Right. I mean, Ilya, for someone who thinks that, recession is...
Although electricity is not so much crude at this point, I suppose.
No, but it's all the same, it's all part of the same story.
But even as a transport fuel, I mean, listen, the trade deals are good in favor of transport activity.
Well, the shipping stocks have been exploding here the past few days, Ilya. They have a...
That would be the front running, expected to go again for another quarter. I mean, that lines up.
Well, you talk about it. There's data out there showing that the cost to book slots on some of these ships has basically doubled overnight.
Yeah.
So if you want to get goods from China right now, it's twice as costly as it was this time last week, in part because there's so much demand now, as you point out. So
that's right.
I guess with the CPI report today, Ilya, I know it comes in weaker, but bonds fall across the curve.
It's a very interesting response here.
Trump's talking up the stock market, and it's like he does not give a hoot about 4.5 on the 10s or 5% on the 30s anymore. Like, that policy Trump put is out the window.
We're gonna find out here, because what seems to have happened here is that the market took the slightly weaker CPI number and said the Fed can cut rates later, not sooner, which is seemingly counterintuitive, but it isn't in context. Because once you start to unpack the inflation numbers, first of all, the core stays unchanged, 2.8%, and that's the bogey for the Fed, because obviously they have no agency over global food and energy costs. Their thing is they need to manage what they can manage. and the core stays unchanged. Moreover, when you look at the internals of the core, it was services that weakened a bit. Goods went from a negative contribution to a positive one, but it's barely a rounding error. 0.02 percentage points from goods in this CPI number, and 2.18 percentage points from services. So services is the weakest in almost 2 years, but it's still the biggest piece. I think the worry was that the trade war would give you massive goods inflation because the tariffs would somehow register as directly a sticker shock. Mm-hmm. And you're not seeing that in these numbers. And so the markets, when you look at equities and you look at what Fed funds futures did and what the bonds did, it all looks like, oh, back to normal, back to maintenance cuts. 50 this year, 50 next year. In fact, the markets are a little bit lighter. They're at 88 basis points, whereas the Fed is at 100. So the markets are now slightly less dovish than the Fed over the next sort of this year and next. And you look at the timing, it's a September cut now. It's not July. So the markets seemingly look at these numbers for CPI and they don't say, oh, it's weaker, the Fed will cut sooner. No. They go, oh, it's weaker, we didn't get the big scary tariff thing. This is more normal. These numbers are normal. They're not crazy. The risk that the tariffs were going to massively skew this, that didn't show up here in these numbers, which, by the way, given the stockpiling in the first quarter, makes sense. So the question now is, are we just pushing this downwind? And if you look at what the bond markets have been telling you, they've been screaming that the Fed need not worry about the inflationary influence of tariffs because break-evens have been going down, not up. So the way this resolves may well be, well, consumer confidence is falling apart, consumer intent is weakening, nobody really wants to outlay because they don't know what's going on, and you just get, again, a regular recession, just a regular business cycle rolling over, but not some sort of a crazy, scary thing. And so the Fed is not in a hurry, but because the maintenance cuts are on, gold holds, dollar sells off.
Well, we see over the past week and a half, basically 2 weeks, the market's taken more than 50 basis points worth of cuts off the board just through the end of this year, which is fairly meaningful. We're currently in the 4.25 to 4.5 range.
The panic has clearly unwound.
It has unwound. This is the lowest close that we've seen in the SR3 Z5 contract since late February, when really stuff started to hit the fan. Dylan, so much of the market in 23 and 24 was defined by the attitude that if the Fed can't cut, it's a good thing. Are we back there? That if the Fed can't give us a June or July rate cut, it must mean that the economy didn't go into the tank, so not a problem?
I mean, that sure is the appealing path to walk down. I mean, and it seems to be the most logical sort of first explanation for why no cut in July, let's say.
Inflation a little bit stickier.
That the economy's more the resilience, the absence of inflationary pressure from supply disruptions, plus the resilience and strength of the American labor market and the American consumer have created a situation where we need not cut rates this month. One of those.
You know, it creates this interesting dynamic where now over the next 70, 80 days, I mean, some of these other country tariff pauses, right? Those are going to lapse before China. There's a small likelihood, I don't know if this is actually going to happen, but you could have a window of a few weeks where there are higher tariff rates on other countries than there are in China, which would be somewhat ironic. What we're seeing here, though, is, at least for the short term, Ilya, we're through NFP, we're through CPI. The next Federal Reserve meeting does not come down the pipeline until, what, June 18th?
Yeah.
There's time. There's time to kick the can down the road. It seems like President Trump was looking at the polling numbers around all this stuff and decided it was a loser issue for him. He passes it off to Scott B last week, who immediately declares victory over the weekend, like trying to get this behind us as soon as possible kind of behavior.
This is the risk now, as it were, right? Because if what matters ultimately is consumption, the question now is, has the damage been done already? And is and what that damage is, maybe not what the panic was in April, but that doesn't mean that the damage isn't done.
But don't you think that the equity markets are showing you that they think the damage is very limited at this point?
Yes, of course. Absolutely. And this is exactly what now presents itself as the key question. If what we're solving for after April's scary spook is there isn't a currency crisis and a sovereign crisis in the United States, well, then solved, clearly. At least that's what the markets are saying. They're saying that that was not a thing, that fear is unfounded. But if what we're solving for,
so now you're back to a growth debate, and you're pretty optimistic.
That's right. You're back to a growth debate, and after this CPI data, you're absolutely optimistic because the CPI data shows you a more normal economy, not some sort of a crazy spook show like what the GDP numbers alluded you might see. And so you now then look and say, how consumers embrace or don't embrace all of this is what this hinges on.
But
because in the first quarter they were defensive.
Will be tempted to come in and sort of hornswaggle the deal at some point and make the whole thing collapse. Like,
very possible. You never know.
At least once.
One good,
just one time.
You never know.
Gotcha.
Take a look, Chris, at the weekly S&P, because on the weekly you can really see sort of where you are in context here. Without a lot of the noise. So look at what we're testing. There's the range. That's kind of the early December into mid-February. Let's see what this guy does to the data range. And then the data sours and there's a conclusion to say, okay, well, what he did to the data wasn't good. Sell it. Now, we're going to find out where we're going to land on it this week. And on the daily chart, the answer today looks like it's going to go and test those highs again. But if you get a weak retail sales number this week that tells you that actually, forget the noise, forget the atmospherics, consumers don't care if Scott Bessent had a nice meeting with the vice premier of China. Nobody's paying attention. What they care about is, are they going to go buy a washing machine or a car in this environment?
Oh yeah, I got a tomahawk steak on Sunday, in part because I knew that the market was going to be green on Monday because of the trade deal.
Yes, but
I was changing my consumption habits.
Yes, but the three of us are degenerates, and that's different. I wouldn't say we represent the average.
But I mean, what to the degree to which they did the polling, they're like, Trump's not doing tariffs anymore. We're going to run tariffs, clean up the mess with Scott. And Trump's going to run a different messaging starting, 2 days ago or something.
Right.
I mean, that in and of itself seems to be a signal.
Well, here's one thing that I think really kind of puts this in perspective. If you want a sort of real-time tally on this, you can look at the president job approval polling, and Real Clear Politics does a real nice average of the polls, so you can get a sense of how things have evolved here. Over the course of, let's say, the past several days, The president's approval rating has gotten worse, not better. And so that tells you that maybe, and again, this is obviously it's skewed by what the average is skewed by whatever polls have actually come out in those days. So, take that with a grain of salt. We've only had a few,
But wouldn't that
really
validate the idea that he wants to distance himself from this whole mess?
Maybe, but it also tells you consumers aren't looking at these headlines and saying, okay, cool, let's go buy a bunch of stuff. It's over.
Yeah, I am.
Well, you are because again, we're not exactly the average that's getting polled in these surveys.
Well, it was one of the things that I bought today. Some NASDAQ calls for the all-time highs.
I was looking today at buying some SPY and some Q verticals, but vol has become so cheap that the pricing has become a little funky.
I don't see it in the chat here, Elliot,
tomorrow.
But the fact that both of us are throwing in the towel here on our recession call after what's been
I am not throwing in the towel on the recession call. I am trading the price action. If you're right at the wrong time, you're wrong.
What's fundamentally different with the price action today versus yesterday?
We've broken back into the consolidation range and undid the bearish breakout that happened in the run from mid-February to mid-March. The price action is fundamentally different.
I think that's fair. Dylan, I look at these charts right now. I can't help but think one of my long-standing heuristics is that when you move outside of a range only to return into it, you go and try and test the other side. It's a false breakout.
Yep.
So we clearly have established that this is a range worth watching in recent weeks and months, right? Yep. November, January, we break it, flips and becomes resistance in March.
Yep.
We're now back into that range. First steps 60-15, 60-20, and then 61-75 again.
Well, and mind you, if I'm buying call verticals here, it is against the existing puts. I am not covering the puts because the puts are at max loss. There's no reason to touch them. They've hit their allowable loss, which was purposefully kept small because anytime you're shorting the stock market, you're fighting a market that doesn't want to go down, just in general. And so it's a dangerous proposition, statistically speaking. You're looking for momentum. You're not looking for a grind. So you size small. I did that by using ETFs rather than futures, so SPY and Qs rather than even MES and MNQ. And I locked in relatively small loss. If this stuff expires worthless, that's not a easy thing to swallow per se. It's about an equity loss of about 4%, but against a year-to-date gain in the double digits, it's not the end of the world.
Mm-hmm.
Next trade.
Dylan, the sector performance here, as noted earlier, was strong to quite strong today. SMH, your top performer, up 3.43%. XLK up 2.16%. XLY up 1.32%. Among the losers, of which there was a handful, we'll call it 9 of the 25 underwater. It's healthcare, it's staples that are two of the big ones on the downside here. So the sector rotation continues to hold up. Obviously, a big part of that consumer discretionary name here is Tesla itself, which is now up to 334. Dylan, I was trying to talk you into looking long Tesla last week when it looked like we were getting out of a potential bottoming pattern here. Is Tesla still valid at these levels? Should we keep chasing it higher?
I think for sure, I think no question, all these names are valid at any price almost. I mean, if this goes, meaning the robot future, whether it's Amazon, Meta, Microsoft, or these guys, Tesla, they're all better bets than most things, even Apple.
Ilya, I mean, Tesla right now is taking off like a rocket
But
ship.
Tesla's in a good way. Sorry. I mean, I think Tesla's in better shape than Apple, for instance.
Mm-hmm.
Elon seems like he could get the best of both worlds for the next 3 to 6 months.
Yeah.
He's stepping out of the spotlight, stepping back from Doge. Tariffs are backing down, so that pressure's off.
He got his way there.
Do we think that the administration is not going to continue to be helpful and supportive of an Elon Musk who is still serving as a part-time advisor 1 to 2 days a week? But he's not going to be
I
the
think
face
this
of
is
it.
helpful. The fact that we're unclenching on tariffs is helpful. That is already kind of a pivot his way. I mean, he wanted
And the fact that he's less visible as an icon of the Trump presidency.
Yeah. He wanted this.
Doge, as it was stated, look, we three have talked about this on our off air. I think Doge was just a power play to consolidate power, right? But the stated goal was to trim the budget and, stop all the deficit
None
spending.
of which is really happening.
None of which happened, which accounting for the errors in payments and mistakes that were made. Doge basically saved no money. And now with the new GOP, $150 billion at the high end, the more conservative estimates where the money can actually be tracked with verified receipts is about $60 billion in mismanaged funds that they found. Again, not fraud because fraud's illegal and there's yet to be a single lawsuit. It's just money that people don't like how it's being spent. 6.2 trillion. That's the new amount of debt we're adding with the latest House GOP bill, Mr. Radigan. Meet the new boss. The same deficit spending lover as the old boss. So we have tariffs off. We have continued government spending at nosebleed levels that equate to World War conditions, just like
and
we
you
did.
got tax cuts brewing.
Ilya, we have tax cuts brewing.
Yeah.
Which deficits up, taxes down, tariff rates, they're higher than they started the year, but directionally, the impulse from where they were on April 2nd is lower.
Yeah.
This all kind of seems inflationary for asset prices again.
Unless you crush the economy.
But where is there evidence of that?
We're going to have to see. And again, it's why I think the consumption
outside
piece
of the first quarter tracking, I guess.
This is why I think the consumption data this week is so important. Mm-hmm. If you've scared consumers to a point where they've decided, you know what, I am going to put off significant spending until this Michigas blows over. If that's the logic, if it's basically like, well, I was going to buy a car and now I'm not. I was going to buy a new washer and dryer and now I'm not. I was going to take a vacation. Now I'm going to do it driving distance versus a flying distance thing. Like if people basically tighten spending in response to all of this and go, you know what, I just don't know, so I'm going to back up. And the same happens with businesses. They go, you know what, we don't know. We're just going to back up. We're not saying we're going to fire anybody or slash anything. We're just going to not do more. We're going to back up. And
but if you're a consumer,
that's a risk.
Here's the thing. Here's like my only side of this. If I'm a consumer who's been in the know enough to change my spending habits because of tariffs over the past few weeks, Dylan, then I'm also a consumer who's in the know to know that tariffs this week may have just been obliterated.
Unless you didn't change your spending because of tariffs. You changed your spending just on general holy moly grounds. And you did that going into this year.
Grounds? What are the holy moly grounds?
My 401k, my whatever, just the market fall in April and March, all the April selling.
Well, and in the first quarter, you get the weakest consumption in almost 2 years, right? How does that happen? Unfortunately, GDP numbers don't unpick you the month by month contributions to the quarterly in an easy way. But clearly there's a response to, whoa, we're driving down the road faster than it maybe wants to allow, and now the car is kind of swerving and kind of hugging the cliff edge a little closely here. Hey, take it easy. Take it easy. That seems to be the sort of read through, and that's before you get to April. So if consumers basically decided going into the first quarter and in the first quarter that all of this commotion is unwelcome, not necessarily tariff related. It's just general, wait, what's going on? We're doing what? Whoa, okay, all of this is untoward. We don't know that, obviously. But we do know that they retrenched in the first quarter before the meat of all of this. And the dust has only been kicked up taller. And the fog has only become thicker since.
I guess the shtick I'm working at, and this totally comes from everything fear or anger based for my trading. In this case, anger, because I missed the move higher. So now I'm trying to work backwards and paint the tape with my justifications for why it's still going to go up. So this mental exercise does press on. Gold up, Bitcoin, Ethereum ripping, bonds down, stocks up. That's a really interesting mix. I'm off the whole buy America, sell America thing. That's over.
Seems to be.
So I'm searching for a new North Star, kind of like a new theme. And if the theme here is deficits up, government's going to have to issue more debt, I think we may be really wrong about bonds as well.
Possible. Very possible.
Like, we probably should be expecting yields to take a ratchet higher to by another 25 or 50 basis points. And I think the 10-year yield is perhaps what's driving me in that direction. If just putting together all the puzzle pieces here and then looking at the chart, it's been moving in these bands over the past several months, like 4.15 to 4.5%. And then there's another one that's like 4.5% up to 4.8%. We're on the cusp of crossing through 4.5% again. And there is a world that makes sense to me where it's like, okay, why are yields going up? Because you're going to get the knock-on impact of the tariffs, which is a one-time bump. But if this is an economy that's functioning like 2022 or 2023, what kept the economy afloat? Why didn't the recession materialize? Because we were spending money like drunken sailors, war-like spending. And yet we're going to be doing that still with the latest budget. There's no big pullback in government spending, which fine. It's not really an issue that gets me out of bed. Dylan, I don't know any politicians that have really won an election running on the deficit, despite how it's been tried for a number of years.
No, but you can run on leveraged growth, which is what a deficit creates.
That's what that creates, right? So higher yields, stocks that can stay up, crypto that is rallying, nosebleed level. Dylan, I asked Tom and
less rate cuts, less, and a bond going down and rates coming up at the long end.
Is this?
I wonder if it's
It just feels like this is
stronger oil.
Yeah, and stronger oil, which feeds into the growth and inflation-ness of it all, and that would be good for higher yields, particularly at the long end of the curve. Where
more activity, more transport and logistics activity in general.
This feels like it's been a really quiet rally in crypto over the past few weeks. Like, it's not a rally that's loved or watched or perhaps even has that much retail participation right now. People, of course, were buying hand over fist when it was last above 100K in January and February, and now no one's talking about this. Is it, Ilya, I feel like, I know you're a bear, you don't believe in it, but the fact that we've gone from 80K to 105 in a lark with barely a peep from the Bitcoin maxis, this feels a little bit different this time than it did, say, post-election. Like, this thing's got more legs than it had previously.
Maybe. You have a weaker U.S. dollar, which really is the only impetus you need here. I mean, is this about the sort of inherent characteristics of Bitcoin as an asset class distinct from overall risk? No. This bounce in Bitcoin is almost to the day the bounce in the S&P, just at double the vol. So the S&P has increased just north of 20%. This thing has increased just north of 40. But the lows are exactly the same. The dynamics are exactly the same. The moves line up almost perfectly. So what are we actually looking at here? Are we looking at some sort of intrinsic Bitcoin thing as separate from general risk sentiment? No. Not really. Doesn't seem like it anyway.
Dylan, do you have a constructive view on crypto here? I know it may be late. It's 105K, but global money supply keeps going up and governments keep spending money like it's going out of business.
I mean, I like your interpretation that the second time around here, like let's assume Trump's a crypto president, or at least fashioned crypto president. Has all those kids from Silicon Valley running around doing, technology money things. Falls apart, and then sort of Bitcoin finds a reason to be through the tariff wars, which revolve around risk on, risk off stuff with the currency in the US, and also enough of an institutional base at this price point to sort of demonstrate some version of integrity within some, granted 40% is a hell of a range, but within some range. But I don't know if that indicates that it's going to go higher at this moment, or so much as it is just validates that, trades around 100. Trades 90 to 110, 85 to 1, whether this is just sort of where it lives now. Or, because I feel like you're asking, is this where it lives now, or is it setting up to have a rip? And I wouldn't have venture a guess on that. But my impulse is that this is an establishment of a place it likes to be, more than it is an indication of some place where it's going.
Ilya, the technicals, it's a range between 74 and 110. We can just do the math there. That's 36K. So we're talking about $146,000 price target on the other side of a potential breakout here. Mm-hmm. Let's work backwards from that. What has to happen over the next few weeks for Bitcoin to get it to $146,000? What's that world look like? What's happened? What's in the news? What's the data? What are the signposts that we should be looking for if this thing's going to continue to go up?
Obviously, you have a very clear range up there. You've just outlined it at 110. So the first thing you need is a technical breakout that tells you that the high that held before isn't going to hold this time. This is not because technicals are some kind of a magic spell that tells you where the markets are going. It's just the basic architecture of you previously had a high. For whatever reason, you decided that the market cannot go above that level, and you tested it multiple times. If you then go above that level and hold above it, well, then you can see with the naked eye, something here is not like it was before. We've reset to some sort of a different level of thinking in this market. For whatever reason, doesn't ultimately matter why. But the architecture of the price action then tells you something different is going on. That you had a high, you tested it multiple times, you couldn't get over it. Now you have, on a closing basis, let's say, that becomes fundamentally a different market. Okay, fine. So you have your momentum indicator. The response from the dollar to CPI today was very interesting because the CPI was a little bit weaker. That cheered stocks. Fed policy expectations actually got less dovish, but the dollar sold. So why did the dollar sell if the Fed policy expectations got less dovish? Well, because the markets clearly were not cheering that the weak CPI made them more dovish. Stock markets were clearly cheering that the numbers were normal. And the sense of urgency was taken off the Fed. This is not like the Fed needs to firefight yesterday. No, this is like, okay, they can wait. This is fine. Everything's okay. And that, in some sense, unchains the Fed. Because if the Fed for the past several months has been sitting here going, we don't know what's going on, our hands are tied, This CPI data says regularly scheduled programming here, gentlemen and ladies. No need to worry. Everything is as you expected. Your maintenance cuts are on. That's it. And then the dollar sells off because the Fed has basically been taken off of emergency rate cut potential in the event that the tariffs suddenly give you an inflation shock. So dollar keeps selling in this environment. As long as that continues to be the story, that's helpful for Bitcoin, just because it's priced in those terms. Nothing much has to happen with Bitcoin itself.
Dylan, if we're looking at Bitcoin at a new high and the NASDAQ moving up to a high again to help my revenge trading work out well, what kind of headlines will we see or will we not see over the next few weeks? What will Trump do and not do?
What will Trump do and not do in regard to what?
If we're going to wake up in a few weeks' time and the NASDAQ's at 23,000,
a
new all-time high. Yeah. Mm-hmm. What will have transpired over that period of time?
Well, you'll get a preview. You'll start to get leaks and a preview of a tax package that people will like, even if it doesn't happen. But it'll be an attractive, as scary as the tariffs were, that's how beautiful the tax package is going to be. Whether it gets through anything will be a different deal. Whether it's SALT deduction stuff, whether it's no one under 200,000.
Pass the salt, Dylan.
Free, no tax on tips. I mean, so that figure, that's helpful in terms of vibes. And then you're going to have no tariff talk, and you have a jump mega budget from the government with deficits for as far as the eye can see. Full money, where everybody gets money. Which, I mean, I think the thing is it's almost on the one hand like a pick a monkey or throw a dart. Like assets will be worth more in that world. Anything you own. And then, so I guess so the game is where the most leverage is either within an index or name or cluster of named. And I feel like you're sort of tempted to be like, maybe Ethereum is going to have its moment here because you're eyeballing it. And maybe it is. Been a long time coming.
Elliot, that tax plan looks like it's going to help people like you and me. My congressman's out there fighting for a cap above 30K, which if, go to 30K, that's just you and I are getting a tax cut in the neighborhood of what, like $4,000 a year, $4,400 a year. And if they uncap it could be several $1,000s more.
Well, and by the way, if a SALT deal isn't done as part of this thing, then the tax cuts expire, and then we get an even bigger SALT deduction because we go back to what it was before. So you and I make out here because we live in high tax states with high municipal taxes, and it looks like people want to give us some relief either way.
I certainly appreciate it.
Yeah, thanks, everybody.
I will do my American duty, my patriotic duty to take that money and put it into the stock market and push this up to highs. Right. So, yeah, no, the tax plan is.
So, I guess like if you were going to just set up a straight shooter's delight, what do you want to be? Where do you get your leverage, Chris? NASDAQ verticals?
NASDAQ vert is what was put into the tastylive follow account today, long the 23K, short the 2350. It's a 9-to-1 risk to reward, risking $900 to make a little over $9,000. It's 48 days to expiration by the end of June. So we're talking about 6 weeks to travel another 1,500, 1,700 points or so. I think that's totally possible, particularly because this is all within the window when theoretically Scott B is handling the negotiations with his Chinese counterparts, and Trump is going to let sleeping dogs rest, hopefully. But a market where I still find the most interesting perverse incentive that's underlining all of this is that in the short term, we still have a market that has been tilted net short. The CFTC COT report that week technically closes in about 9 minutes and 10 seconds time. And we're going to see the data for up-to-date positioning come this Friday at 3:30 Eastern. But before we had yesterday and today's moves, before we had all this trade talk, we were looking at a market where people in the futures were still net short. And speculative positioning tends to be something that's operates contemporaneous alongside price action. So as the market goes up, traders tend to get long. As the market's going down, speculators tend to get short. They're trend followers. So you have all these people who have been short, staying short, not budging off their shorts as the market's climbing and climbing and climbing. And now, not tomorrow, but the day after, we're going to hit the halfway mark for 2Q. And if you were an institution or a hedge fund that bailed in the first week of April, Lucy, you got some splaining to do because stocks are back unched, if not positive year to date. So Dylan, I think there's this really weird incentive right now to push things higher, to chase, right? You have 6 more weeks to make up for the first week of April, particularly if you
And
bailed.
you think the NASDAQ vertical is the best place to for a capital efficient, leveraged long into that idea?
I do. Last week, when the news of the UK trade deal was coming out, I tweeted out, if it's not EU or China, it doesn't matter. We don't have an official deal with China. China's attacking the UK trade deal with the US, but it's clear that we're on an off-ramp right now. This is a market that didn't fall today when Xi Jinping last night said to the world, we've learned that bullying leads to isolationism. That's a direct attack against Trump. Trump didn't say a peep today about being insulted by the Chinese leader like that. Maybe it's because he was on a plane. But I don't know. It feels like Trump's moved on for the foreseeable future. And now that we're in peak shipping season and peak ordering season for the holidays, he can let this go. If he wants to kick the tires on this again in 2 months, in July or August, wouldn't that work out nicely with the seasonality, Ilya, where it seems like every year we rally, April, May, June, July, and then August 1st comes, go away until October 1st? That, feels too perfect.
And again, this is why you got to look at the consumption numbers. If you make all of this contingent on the market is following the optics, then clearly there's absolutely no question that the market is telling you the optics are much better today than they were yesterday, that they were better yesterday than they were last week, and that they were last week than they were the week before that. Very, very clearly, the markets are telling you the optics have improved. The question now is, you got the sell-off started not because of optics. You got the sell-off started because of real economic data telling you that things were cooling off in a worrying kind of way. None of that has changed. None of that data is any different. Now we have to see if, in fact, what has been done to business and consumer sentiment is like markets, driven by the optics, or something more insidious. And we just don't have that answer. We don't have the data to tell us that answer. But tomorrow, the day after that, we have some really key numbers that are going to help to answer that question. And in particular, it's the retail sales report, but I would argue even more importantly, it is the University of Michigan consumer confidence numbers that come out on Friday. If those consumer confidence numbers are bad...
But now you put yourself in Chris Vecchio's chair because he's sitting here like a fool. And he's a very optimistic fellow with a very, positive worldview. And he just watched this thing jam straight higher on him. He had nothing on, or not enough anyway. And so now he's sitting here looking to figure out why this thing's just going to go hog wild for the next 6 weeks.
You might be right.
And you're in there trying to do dental floss on the Michigan confidence number, looking for the problem. Maybe you just need to relax.
I am not suggesting that this thing is not going to rally back to, let's say, NASDAQ 22.5.
Okay.
Because that's exactly what the price action here looks like. But that does not mean that we have a buy in July and
buy through July.
Buy through July kind of dynamic here, because we just don't know. We just don't know. It's why, I mean, trading the price action today, I was actively sizing up buying call verticals to reduce my short delta exposure. Because, I mean,
for good reason.
The put verticals at max loss, it's basically just dead money. And there's enough duration in it that there's no point to change anything. You just leave it, because worst case, it'll stay where it is. And if you are also then holding some call verticals going higher, well, then you eat away at
But how
the
funny
net,
is it if the next story is not even AI, but it's
but
just
this is exactly why I'm skeptical.
What if the next story is just American deficit spending?
This is exactly why
tax
I
cuts.
am so skeptical. Exactly why. Because you look at this rally in the stock market, and what it looks like, it doesn't look like the triumph of AI. It doesn't look like the super glide. It just looks like we almost took a sledgehammer and hit ourselves in the face, and then by some miraculous luck, we missed.
So this is back to neutral.
Yes. And now we have to find out where the economy is, where it really is.
We had the Zweig breadth thrust a few weeks ago.
I learned about that when we started talking about it.
Yeah. So for those that don't remember, Zweig breadth thrust is when the NYSE advancers over the total NYSE advancers and decliners, that ratio moves from 0.4 above 0.615 in a 10-day span. Along those lines, we just saw another pretty good breadth signal today that just came out of this market. This comes from Ryan Detrick, friend of the show, over at Carson Research. Today, we have 60% of the components in the S&P 500 hitting a new monthly high. Very rare. Doesn't happen that often. How many times has it happened before? 16. Going back to 1980. What's the average return for stocks after you have 60% of components hitting a new monthly high in a single session? 1.4% higher on average a month later, 5.1% average 3 months later, 9.4% on average 6 months later, and 18.6% higher on average 12 months later. The hit rates are 83.3% for the 1, 3, and 6 months, and 100% of the time for the 12 months. So as we go out with today's overtime, right, CPI doesn't leave a dent. The market sells off a little bit into the end of the day, but breadth is improving here. Stocks are back above water year to date. Didn't have that on my bingo card a month ago, clearly. This has been the craziest 6 weeks I've ever had in the market.
There you go. There you have it. And with that, out overtime is out of time.
Yeah.
We'll see you all tomorrow. Same time, same place, 4 p.m. Eastern, 3 Central.
Yeah. Godspeed, everybody.
For Dylan Radigan and Ilya Spivak, I'm Chris Vecchio. Good luck trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get backtesting at Tasty Trade.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
tastylive's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging, and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number 1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, 2 female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
The beauty of Thinkorswim was that we were different. From the name to the front-end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. You know, that's what I do.
Oh, yeah. Tasty Nation, good morning.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at Tasty Live.
If you missed the live show, here's our cherry on top weekly recap.
I got my Ted Lasso.
You actually have pants on.
Yeah, of course. I'm in school.
Huh, got it.
You're flexible.
Yeah. Oh, nice. You are pretty flexible. Let's see, get that leg up again.
Oh yeah, he's really. Right now, my other leg is cramping.
I believe that to be true.
Got the need for speed? No problem. At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. You know, that's what I do.
Oh, yeah.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at tastylive.
CPI data comes and goes in the U.S., and the markets seem to like it. So where are we going now? That's the question we're going to ask ourselves here on Macro Money. This is Ilya Spivak, head of Global Macro here at Tasty Live. And we are going to take a look at what this CPI data did and try to focus on unpicking the details in this data to try to surmise what the market reaction here to these numbers is actually telling us. Because clearly here, the markets on the stock side liked it, but that only tells us a very small bit in the story. Now we have to go and unpick what some of these other markets did, because indeed we get a very interesting perspective here for the cross-market reaction that starts to explain a little bit more about how this is likely to evolve and what message these numbers are giving us here. So we're going to take a look here first and foremost at what were the numbers that came out, what were the contributions that the CPI data told us came from which part of the structure and what that means, but really most importantly, what the price action response was telling us. So let's begin here with the market reaction. As we said here, it looked like it was relatively supportive when we consider what's going on here with stocks. This is the S&P 500 here, just as a bellwether for overall risk sentiment. And we can see here, not only have we posted a rally, and that, of course, tells us the story already, but we very tellingly broke back through this key level of former support become resistance at the bottom of the range that was in place from late November into December, where we set up this high from which, of course, we launched a very concerted sell-off. This was the consolidation. Right here was where the sell-off got kicked off. We have now retaken that critical barrier here. And anything below it still looked like a correction within this overall decline. Well, now we look like perhaps there is a pathway from here higher back towards 6,000 and back to test these highs. So not only did the markets generally rally on the day and did so in the wake of the CPI data, they took about an hour to digest the CPI data, then rallied, but they did this through critically important and sort of obvious with the naked eye barriers in the price action. And that seems to belie a level of conviction. Likewise, of interest, of course, is that with these numbers, the U.S. dollar weakened. We can see the dollar started the week on strong footing. This is the DXY dollar index. It's a bit of a skewed basket because of all the legacy currencies in it that have since become the euro. But nevertheless, it does give you some sense of kind of an average trajectory for the dollar against its major counterparts. It ultimately sustained the most damage against risk-on currencies like the Aussie, which of course makes sense in a kind of stocks environment that we just saw. The euro didn't do as well, the yen didn't do as well, but certainly the overall direction for the dollar here was lower off this former support become resistance right there. And gold prices very tellingly held on to their range support. As the dollar rallied yesterday, gold sold off into this range right here. And whereas the dollar held back from rallying through its relevant near-term barrier, so did gold, but on the other side. It managed to hold up without selling off through its major support here and held right there. So what was it in the CPI data that did this? Well, looking at the numbers, the headline came in a little bit softer than expected, 2.3% versus 2.4% expected. The core in line with expectations and unchanged from the prior month, 2.8%. Now, it's important to consider what these reference points are here. 2.8% is actually the lowest core inflation that we have seen in 4 years. The last time we were below that was March of 2021. So exactly 4 years in March, and the April number here was unchanged from that. The headline is actually the lowest since February of 2021, when inflation was just 1.7% year on year. So this 2.3, a welcome improvement, needless to say, but only modestly so relative to expectations. If we look at the internals here, what we find is that the main contributor, not surprisingly, still services, but also that services inflation continues to cool significantly. And to the extent that a lot of this other stuff amounts to a rounding error, this right here is getting some welcome proximity to the Fed's 2% inflation goal. Indeed, at 2.18 percentage points, this is actually the smallest service sector contribution to overall inflation since November of 2021, when it was exactly at 2%. So we seem to be looking at some welcome progress in the Fed's direction. Moreover, goods inflation, although it's flipped to positive from negative, we can see in March, goods were actually a disinflationary force here, but for the overall number, deflationary for goods. And now we've kind of flipped back into positive territory. There's not much of a difference in terms of the contributions from food and energy, similar uplift from food March to April, similar downshift for energy for the same period. But if we look at the actual changes here, clearly the real action is happening here and here. And what seems to be the key takeaway is that the part of the economy where there is the most pull from demand, you can clearly see where the demand is because we can clearly see that inflation is in services. It isn't in goods. Now, the reason this is here and the reason that this wedge from goods inflation basically gets unwound as we work our way through 2021 and 2022 is what the Fed was saying back then about the transitory effects of COVID disruptions on inflation. Broken supply chains made goods more expensive. As those supply chains mended, that goods inflation got squeezed out of the equation. And what got left was sticky services inflation, mainly driven by domestic demand, including, of course, in the calculus here, the incredible burst of stimulus that stoked consumer demand, including the Fed's efforts at cooling inflation that helped to underpin that demand, including, of course, also the labor costs embedded into the part of the economy still growing and locking those in. Of course, the service sector is by far the largest employer for the U.S. The ratio is something akin to 75-80% of employment is accounted for by services. So if ever high wages during labor shortages at the start of the unwind from COVID lockdowns were going to be seen, they were going to be seen in services with a much more significant impact than elsewhere. So we clearly see that this is where the demand is, which is why this is where the price pressure is. Price pressure and demand go hand in hand, of course. When there's demand for a particular sector's output, the prices are going to reflect that and be relatively uplifted. Not surprisingly, of course, during the COVID years with everything on lockdown, the emphasis was on goods, not on services, because one could not partake of a lot of those services. We, of course, talk about subsequent revenge, quote-unquote, spending on things like travel and concerts and all those things that you couldn't do during the lockdowns. And so there was a kind of wedge here of gorging on goods that then kind of hit a wall. And then services really took over as the dominant engine of demand. Of course, we've talked about this and seen it in the PMIs very clearly, where manufacturing has been anemic, but services strong up until the beginning of this year. And we likewise have, of course, seen that the U.S. economy was very strong last year, but that didn't spill over to the global economy, largely because it was mainly services demand, and that's serviced by domestic firms, whereas imports are mainly on the goods side of the equation, and we can see that demand, as implied by the price impetus here, is basically flat to non-existent. And so that's what makes these numbers so interesting. The weakening part of the equation here comes from, mainly at the core, and obviously this 0.7% and this 0.3 adds up to 10, and these two cancel each other out. But the main impetus here comes from that part where growth lives. And on the good side of things, any concerns that there might have been about maybe the tariffs would create a big inflationary distortion that the Fed worried would tie up its hands, that clearly did not materialize here, at least not yet. And perhaps the reason that it didn't is what we saw in the first quarter GDP numbers, where we saw massive front running of the tariffs with a huge surge in imports and then a parallel surge in inventories as those imports got stashed into warehouses, anticipating that tariffs would make prices go up, and so buying in excess to try to smooth out that impact as much as possible made sense. And that's perhaps why goods prices don't really reflect all of the tariff chaos that we have seen. We can see, likewise, that in the wake of these numbers, the markets actually take Fed rate cut expectations down and not up. And that's a very curious read-through for all of this and helps to explain why the dollar did what it did. Now, if you get slightly cooler inflation, 2.3 versus 2.4%, you might expect the Fed could have clearance to cut more readily. But that is not how markets interpret this. You can see, of course, at the peak chaotic period here in early April, the markets were looking for as much as 137 basis points in cuts. That has, of course, unclenched. But in the most recent days here, we've gone to just 88 basis points in cuts through the end of next year. That's a little bit more hawkish even than the Fed's own outlook, where in December and then again in March, they called for 100 basis points. Now we can see we're basically there. For this year, we have 47 basis points priced in versus the Fed's 50. For next year, 41 versus the Fed's 50. So we're very, very close, but slightly less dovish even than the Fed. This weaker CPI data doesn't do anything to change that. As a matter of fact, we're narrowly pushing out when the next rate cut is going to happen. Here's the calculus for the July meeting. We can see that whereas a week ago, a rate cut in July looked like it had better than even odds, approaching 60%, we look now and the markets don't expect that there is a rate cut that's going to happen in July. They see an over 60% probability that we don't have one. This is the current setting of policy right here. Moreover, you can see the delay in September's numbers. We got a little bit likelier chance of standstill, a little bit less of a probability of a cut as we look to September's numbers. So the markets looked at this CPI report, saw that it was a little bit weaker, and ended up saying, oh, well, this probably means the Fed can have less urgency about rate cuts because there isn't some emergency that's going on. This breakdown in April looks very much like the breakdown in March. The overall inflation rate is a little bit lower. Core is steady. There is no tariff shock here. And so the Fed need not worry. The economy is at an even keel. So there is no urgency, and perhaps we're back to normal maintenance rate cuts that the Fed intended all along for this year, well before even the calendar turned to 2025 or even before the election. Already in September, the Fed was eyeballing rate cuts this year and next year, just because inflation expectations have fallen and it's been time to move nominal rates down in line with that, because otherwise real interest rates surge and crush the economy. So that helps to explain how, even though you got inflation a little bit weaker, Fed rate cut expectations actually moved to a less dovish setting, yet still the dollar sold off and gold found support. Because whereas the Fed's hands looked tied as they were trying to figure out what influence the tariffs were going to have, now perhaps their hands are not tied. Now perhaps they can proceed with these maintenance cuts at a leisurely pace. And that's how all of this seems to fit together. But of course, the key question here for markets that until this point were very much focused on how much panic the inflation numbers would endorse, is what's actually occurring under the surface beyond that story. Because again, going back to the S&P here, we did not start this sell-off because the tariffs were hitting fever pitch. That ostensibly happened earlier. We started this sell-off because the data started to show that what is happening with the rollout of fiscal policy is creating a kind of dampening effect for consumer and business confidence, and that is hurting economic growth. And we don't know if any of these back and forth headlines over the past 4 to 6 weeks have changed any of that. The PMI numbers certainly suggest that it hasn't. We continue to look at standstill implied by business confidence numbers for April, but of course they don't capture this most recent news. We'll see how the revised S&P Global PMI numbers in their next iteration end up looking. But as it stands now, business confidence is still very much in the doldrums. And the real question then becomes, we already saw in the first quarter that the growth in consumption, which at 68.5% is by far the largest contributor to GDP, we already saw that it slowed to the weakest since the second quarter of 2023. That is the weakest in almost 3 years, almost 2 years rather. And so with that, the question really is, are consumers paying attention to any of these headlines, or are they just ingesting that there is a lot of back and forth and a lot of noise and retrenching broadly without account for the granular details that, frankly, people like me obsess over? And we're going to find out, because later this week we are going to get a real check on where consumers are. Expectations for retail sales this week that they're going to come to a standstill in April. The year-on-year rate expected to come down to the lowest we'd seen since early 2024 at 1.1%. And consumer confidence expected to hold near the recent lows, where we got, because of expectations that what the tariffs would do is increase inflation downwind. 1 year inflation expectations in the March survey here up to a blistering 6.5%, worse than it was at the post-COVID peak. And of course, with the tariffs on China now on average 30%, and maybe coming down to the new floor of 10% if all goes well, even in that best case scenario, we're still looking at much higher tariffs. On average, a 5-fold increase versus an average tariff of 2% before any of these gains. And if consumers are not getting any happier as a function of these headlines, looking at the data, well then what we're seeing in stock markets may well just be a blow-off sentiment sweep that doesn't survive contact with what the real economy is doing. And for that, we'll ask consumers this week, see what they say. That's Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. In just 30 minutes' time, I'll be on, as I am every Tuesday, with Victor Jones for The Price of Truth. So come check out that conversation. It is always interesting. I'm on with Chris for Futures Power Hour Mondays and Fridays. Back with Victor and Tom for First Call Sundays. Writing for the news and insights portion of tastylive.com. And commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastytrade. Download today.
I tend to call myself a lonely options trader because I really don't have a lot of people that I can share stories of wins and losses with. Like tastylive plays the whole day at my house. I love that they've made everything really easy to digest and take in. I love that you can easily send an email if you have any questions and Tom will be quick to respond to you, or if somebody else, Nick, Tony. I really enjoy that it's a customer focused and it's a customer centric system that you guys have here. And tastylive has definitely changed my life financially because I'm able to determine how and where I can make my gains and not be a passive investor where you're just relying on the markets to do something for you. You could actually go out there and do it yourself.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
tastylive's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging, and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
Diversify your portfolio with stocks, options, futures, crypto, and more. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Tasty Trade. Download today.
What is going on, everybody, and welcome back to Risk of the Week. Today, another volatile week in the market. We got a lot of bullish headlines over the weekend and throughout this week so far. So let us know what you're trading. Let us know how you're managing it. Today is Tuesday, where we put on a new risk. So we'll see how our trades from last week panned out, and then we'll go ahead and talk about the ones we put on today. But before we get into it, Gus, my brother, how are we doing today?
Oh man, doing great. Yeah, I've been long delta throughout this entire bull cycle.
Must
I've
be nice.
been taking profits, taking names. It's been a good series of days here. Just basically stacking the capital back up and getting ready to redeploy. You never know when we might get another volatility event. So, yeah, feeling good, feeling juiced, jazzed, ready to go. Managed to get out of this aim at position that's been annoying me for like 2 months today. Finally, I was so marginally up, and it's just been down forever. And I was like, get this thing out of my account. So I was very happy to see that flip green. It's been a good day so far. How about you?
Good to hear. I know you've been really long Delta, so I know days like this are really playing out in your favor. So I'm cheering for you on this side of things. But I mean, things have been going well over here too. I'm not as long Delta. I have some short Delta on in QQQ, in SPY, of course. I feel like I always have short Delta on in there. And then some of the trades from last week worked out really well because of that gap up over the weekend with a lot of talks on the new trade deal, going back and forth with China. Apparently, the market had a positive reaction to that. So I woke up with Apple gapping up, Lulu gapping up, those names gapping up. So just taking those off into this rally and putting on some more risk of the week, as we'll get into here in a moment. But things have been working out really well. What are your thoughts on the recent rally we've seen over the weekend and continued into today?
Yeah, it's very interesting. I mean, obviously, the initial rally out of the Liberation Day stuff came with the tariff pause, but now all of this is actually being driven by some more legitimate tariff resolutions. And every time we start to reach a resolution with another country, it makes me more and more confident that we might have things figured out by the time that July 9th date rolls around, and that may not be as parabolic as I've been pricing in my mind this entire time. So yeah, I think it's very interesting. I've enjoyed keeping up with all of the China news. Been trading a little bit based on that action as well. Yeah. But yeah, it's I don't know. It's funny. I mean, it's like, we're almost just back. I mean, SPY is almost back at 600 or SPX back at 6,000, whichever you prefer. But we're chugging upward, and it's like, holy cow, are we just going to rip up and all of a sudden do a 7% year? Like this could be kind of crazy if this momentum continues. So yeah, it's been very fun to look at in the macro. And I will say the trades are getting less and less easy and plentiful by the day. We've had a few weeks here. We've had a few weeks here where I was never even considering, let me find a bearish angle. It was always, I could just throw that out and I could just say, let me find something that I think is going to continue up or that is lagging behind the rest of the market and will catch up, which is what I've employed with our few previous risks of the week, TNA, Victoria's Secret, these things that tend to lag, and those have worked out very well. But now that we're starting to get near the top again, there's not as many things where I'm just like, oh, this is a no-brainer that this is going to return to X level. So it does get a bit more challenging. It's always nice. And I said before that was the environment I was trading in when I very first started trading, was the COVID recovery. And I was like, this is the easiest thing in the world. I just buy a naked Apple call and I make $400 in 20 minutes. It's awesome. So yeah, it's, where the days are running out on that ease.
No, I hear you completely. I mean, hey, could you ask for anything less, Gus? I mean, being that positioned long Delta, I mean, could you ask for anything less on the rally that we've seen? So, it sounds like the dip was just a little bit of a stop hunt, if you will. And maybe we're back at all-time highs. I don't know. But we do have that time window with the tariff pause. So we'll see what we get throughout of that. But it is risk of the week, Gus. As we dive into this first slide here, it looks like things are working out pretty well so far. I know you've been pretty much long on most of your positions. Now it looks like we're getting on a short position here. Let us know a little bit more about it.
Yeah, so I'm gonna try to get cute and contrarian here. I haven't done this since our very first risk of the week, which is the only stain on my record from that first slide was the first week when I decided to try to get contrarian and go against the market. I'm doing the same thing here. It's been a lot of good China news all week, and I am getting short on Alibaba. So I've taken a bear put spread. It's 10 DTE. It's already May 13th. Golly, it's 10 DTE. Expires on the 23rd. I have bought the 139, sold the 137. So Alibaba, they recovered quick out of the Liberation Day pullback. They're already trading around 10% from their all-time highs. If you look at it from a TA perspective, it's very much back to what would be considered normal levels for this company. And there's been this great week as this trade war with China, begins to become a little bit more clear. The uncertainty is coming off. And we've seen gaps in Alibaba as this news continues to break, which makes sense. But I do think that their sales are going to be down for this quarter amid all of this tariff uncertainty. I think that some people have probably laid off. Maybe the drop shippers were loading up when all of this was rumor and have since stopped, as it's become more difficult. And I think that their forward guidance is going to be strong, especially with the news that's been breaking this week. They have an earnings call on Thursday. I should have mentioned that at the beginning, Thursday after the close. And their forward guidance is probably going to be good, and all of this news has came at just the right time. I'm sure that the leaders of Alibaba are frantically updating their forward guidance with every bit of news that breaks. But I just think that this run-up this week has been a lot in response to all of this news. There's gaps to the downside that need to get filled, and I'm hoping that poor earnings numbers, I'm hoping that they will miss expectations for this quarter based on all of this tariff uncertainty hurting their sales, and that will be enough to outweigh that poured forward guidance and bring them down just a little bit. This is 10 DTE. This is tight. I don't need it to stay below these levels for months and months at a time or have some continued downturn. I just need a small, even 2 to 3% gap down on this earnings, and that would put me in a pretty favorable spot for this to expire with max profit. So yeah, that's my sentiment on Alibaba here. We will see if I get burned, and I will add that I'm long yin, which is 3x China bullish shares. At the same time that I'm short Alibaba, so a little bit of contradiction going on in the portfolio right now. But that's my thought process. We're shorting Alibaba.
No, I like it. Getting involved with some of these Chinese names. I know the one that I had chosen for today. It seems like a lot of the underlyings we're choosing right now are going to be heavily affected by the tariff outcome. So Baba's going to be an interesting one, especially because this is a country we're in one of the biggest trade wars with right now. So a little bit of a 2-3% gap down based on the potential volatility. I don't think that's too far-fetched. I like it.
My job as a God-fearing American to short these companies. Yeah, no, but like I said, I don't need it to be cataclysmic. Just need a little bit, just a little tiny sell-off. Mike, you make a great point about the data centers. I'm telling you, man, this cloud computing and these data centers, they just fly under the radar. You never think about them unless you put in special effort to make that happen. So, certainly, and again, it's risk of the weeks. Of course, there's going to be a little bit of risk here, but I feel like there's a better chance that it moves down than it moves up. And if it does move up, I'm 5-1 in this series. I can afford to eat one.
But is that not all of our trade thesis? I think there's a better chance we could be going up, or I think there's a better chance we could be going down. True. So I'm positioning myself this way.
It's all the expected value equation. So yeah,
100%. I know on this one, Nvidia is looking a little different here, but Nvidia, we're going to be looking to get short some Nvidia. I know the semiconductor space, this space has been a little bit more quiet after the insane rally that we've gotten over what, the last, I think it might be a year now, I think, when all the semiconductors in Nvidia was popping off, but Nvidia has been brushed under the rug. It was the most popular name. Now it's not in the headlines. Nobody cares about it, but Nvidia's been going on an absolute tear to the upside. So I did position myself short here at the same time, Gus. So both of us are positioned the same way. So the call spread went for June 20th, not doing the 10 days. There is earnings within this cycle period for Nvidia, so I chose to go a little further out because I don't want to get in the way of that. But I was able to collect about $1.72 in credit. Sold the call spread, got a little aggressive. I believe it was 43 delta, 46 delta, somewhere around there. So it was a little aggressive, but excuse me, a lot of the valuations resemble kind of like a .com era extreme. I'm not calling the top on these stocks. I'm not saying it was a bubble, but it was looking like price was rapidly increasing faster than the valuations for the overall company could keep up. So looking to be a little bearish over here on Nvidia. And I don't want to use the word scared, but I'm not as hesitant is a better word. I'm not as hesitant to trade Nvidia, or at least get shorted now that it's cooled off a little bit now, because it was on the no trade list for me for a while, right behind Tesla.
Yeah, it's true, and I think that this is another I think this is another good spot where you can catch something that might be overextended and trying to price in all of this news and earnings to too great of an extent where it could just take a slight step down off of earnings or just into the next week, could move on sentiment. There's all sorts of ways that this could move. So yeah, I'm here for it. It's I'm seeing gaps to the downside over here as well. Also, Emmett, thank you for the compliment on the shirt. Shout out to my dad for buying this shirt that didn't fit, so I have it now.
Okay.
But
no, your dad was giving you gym motivation. That's exactly what it was.
Yeah, right. But I like this Nvidia trade. I'm here for it. It's obviously inherently risky. It feels a little bit contrarian and crazy to be getting short Nvidia in this environment, but it's risk of the week. That's what we do. Somebody has to be the contrarian. Somebody has to fill these long orders that are going to be successful.
Orders. Thank you, brother. Thank you. I'm glad we're on the same page there. So somebody's got to fill these orders.
And I noticed this Nvidia logo. It looks really familiar. I can't place it, but
I'm glad you like.
it really reminds me of tech. I can't explain it.
It's that nostalgia feeling, you know.
Yeah, it looks kind of stupid, honestly. I don't think anyone would buy any products with this logo on it. Really, it's kind of like,
100%.
Why is there a bite out of the apple? Just do a whole apple.
That was me verbatim maybe 15 years ago. No joke. Like that was me right before iPhone blew up past the level it already blew up at. So we'll jump into this platform here. We'll take a look at these underlying, see how the market's been responding. But I mean, the market straight face ripper all day today, Gus. I mean, last 10 minutes, we got a little bit of a sell-off, but this market environment is no joke.
No, yeah, it's been a fun one. Yeah, we'll definitely take a look at Target here as well for our man Gregor. But yeah, a face ripper is a good word for it. They say that stocks take the stairs up and the elevator down, and that has not been the case in this recovery. We are taking the elevator both directions. We're saving the leg work on the way up.
100%.
So yeah, I mean, like I said, it's just I loaded all those shares at the bottom, so it's basically been exit week for me this week. There's been a lot more exits than there has been entries.
I like that. I mean, I like that. Target. You haven't traded Target recently, have you, Gus? But I know we got Target over here.
I haven't.
It's been a little while for myself on Target at least, but Target's been absolutely beat down. Pretty decent IV rank. The volume is there, so the liquidity is there. What is the options chain looking at? Let's just take a quick peek. It's looking like we have earnings before the bell, May 21st. So that's about 8 days away. So next week, that's something to look out for. July cycle, I mean, the premiums right off of the bat, like sometimes my eyes will go straight to the expected move. I'm like, not the most attractive move because, I mean, we're not even near the one standard deviation move on Target, and we're all the way in the July 18th cycle. So maybe this is something you could look to putting on a debit on. Premiums aren't looking as attractive. I mean, even if we go to at the money, we sell a $5 wide, we get $1.80, which isn't bad. But then again, we are trading right at the money. So it's been a little while for Target. I'm a little bit more on the Walmart side. I kind of grew up going to Walmart, so it kind of has a soft spot there. Target, don't get me wrong, Target's one of the GOATs. Yeah, I love me a nice little Target run, especially after a fresh haircut back in the day. So I don't know what your thoughts are on.
I think you explained it pretty well. Target definitely has some nostalgia value to it for me. It used to be lit when you were a kid. You go to Target, man, get some popcorn or an icy or something like that. Walk
video
around.
Game section.
Yeah, video game section. Hop on the little example consoles and play some Mario Kart or whatever. But yeah, Target, it's an interesting one. I mean, they're at north of 5-year lows now. I actually just manually scrolled 5 years back on my chart until I hit the wall, and I could not find a time that's been lower than this. So it's 5+ year lows is what we'll call it. And yeah, it's an interesting one. I have a hard time, markets aside, I have a hard time as a consumer kind of seeing where Target fits into the broader retail space, especially as things continue to evolve. I don't feel like Target offers, you look at a Walmart, it's like, okay, they have, tires. Walmarts will have guns in states that with looser gun laws, things like that.
Right.
And and Walmart's expanding into the grocery section now, and I feel like there's just nothing that really differentiates Target. They kind of have a vibe. There's certainly a brand there, but I don't know as far as the future of this company.
They're in a gray area.
Yeah, they are. They are just kind of in limbo. I feel like, I mean, my impression at least is that they sell roughly the same goods as Walmart, but at a slightly higher price. Target does have good offerings for clothes, like staple clothes, T-shirts, pairs of pants, things like that. I think that they have a place, but I'm not surprised with the continued decline, especially in the ever increasing competitive retail environment. So I'm not really sure. It feels like it's probably oversold if I just scrolled all the way to as far back as I could go on my chart and couldn't find a time that it's ever been lower. But also, while the entire market is recovering out of this Liberation Day stuff, Target made a small recovery and then just continued to lag to lower lows, which is uncharacteristic of almost anything else that we're seeing in the market right now. I think gross is the word that I would use. This is sort of just a gross looking chart. I don't know if I would touch it.
No, yeah. I mean, Target's been absolutely beat down. I know it's not as bad, like Lone just mentioned here. I know it's not as bad as Kmart. Excuse me. Shout out to Kmart. Shout out to all the Sears people. That's definitely in our memory bank. A little bit of nostalgia there, but excuse me. Target's been going strong. So it is in a weird gray area though, because Target, I mean, I don't know how many people, maybe some do in chat, but purchase groceries from Target. I know when I think of Walmart, I know we have other merchandise at Walmart, but like the core of Walmart to me is like groceries and then everything else after. Like I know it has video game section, houseware, kitchenware. It has everything else, but it's like the core. Walmart wouldn't be Walmart without groceries. Target, right? There's a Target and then there's a super Target. Target could be Target without a grocery store. So it's like Target is more for those other merchandise. Either way, gray area. I know Publix out here. I know Publix in Florida and somewhere on the East Coast is a lot more popular. And then other things like Trader Joe's, these other grocery stores. So when I think of Target and I think of Walmart, Target relative to everywhere else just seems like it's in an awkward spot.
Well,
like,
yeah, I think the way to quantify it is like if you name grocery stores, Target isn't going to come to mind very quickly.
No.
If you name department stores, Target probably won't come to mind until the third or fourth one that you name. And so what are they? Where do they fit into this calculus? You know, it's a weird thing. And conversely, a company like Walmart, they would be the first or second company I would say is my answer to both of those questions. So it just, it feels like there's other people that are better suited for this environment right now. Mike says, I think Target's going to get purchased by someone. I keep buying shares in the dips. That's an interesting thought. I could potentially see that. They obviously have massive infrastructure and numerous locations all over the place. So perhaps a good buyout candidate. That might be a good shout. But outside of that capacity, I don't love Target as a company. Yeah. I don't think that their fundamentals are any better than, say a Walmart or a Kroger or a Publix. So yeah, I certainly can't get there. I don't know that I would get short either, though. It's hard to get short at 5+ year lows as well. It just kind of feels like a ignore to me.
And I mean, excuse me, buying the dip every time Target is dipping, somebody's going to buy them out. I don't know, Mike. It sounds like you might end up being the majority stakeholder because if you keep buying the dips on the way, I think we got a long way down. So, no, I'm just kidding.
Yeah, Mike, if you're about to flip to 51%, please let us know.
Yeah, let us know because a few more dips, you might be
Warren Buffett acquisition of Target there.
Yeah, 100%. Quick tour to market. Obviously, market's been rallying like crazy over the last few days. Let's change the time window on some of these real quick. Go to the daily. There we go. So, I mean, just looking at the daily on the S&P 500, absolute face ripper to the upside. I mean, just barely a month ago, we're trading down to around 485, 483 on SPY. Now we're trading at around almost 600. So just shy of 600. That's a massive rally in such a short period of time. So I know I still have more short positions on in SPY, QQQ. Maybe we get a decent pullback after this insane ripper that we've had. But on the contrary, because the market's been ripping to the upside, volatility has been getting absolutely crushed, which you have some directional positions on. Well, you did have more directional positions on to the upside. And then also vols coming in at the same time. So you're getting that directional move and then that vol crush. I mean, you're in such a good spot. So volatility been getting absolutely crushed and still sitting at 18, despite it trading at around 62 over back early April. So, I mean, the overall market feels like volatility has been really contracting, but relative to where we've seen a lot of 2024, we're still sitting in a pretty nice area, in a pretty good spot. We're not doing too bad. So there's SPY and there's VIX. Here in a moment, we'll get into the other positions. But what are your thoughts on volatility before we move forward, Gus?
Yeah,
definitely a different environment.
I just think it's funny how quickly sentiment shifts, and it's not a fault of anybody. It's what you have to be able to do as a trader and trading in the way that we do. Right. But all of a sudden we're like, oh my God, volatility is so low. But as you said, I mean, we're really just at pretty typical VIX levels here. You have to snap into the conditioning of VIX is at 50. The world is the sky is falling. Right. And, so it seems like this pronounced contraction and volatility. Really, we're just returning to where we were before these volatility events. I don't see any problem with that. However, I have said on the show numerous times, Errol, if VIX gets below 20, should I just blindly go long? And perhaps I have to.
Honestly, during this administration, it might be a no-brainer.
That's what I'm saying. If it gets below 20, I feel like I can just go 60 days long on VIX and wait. And that has to print sometime, right? Chat, what do we think?
Your VIX has been printing. I don't know if you used to play 2K, but when you hit a 3 perfect timing, you get a green light. I think you got the low 20s a green light. Splash. The animation.
Yeah.
But we got SPY on right here. We have 38 days left till expiration, so we still have until June. A lot of time for the market to do whatever it needs to do, but you can see how I'm sitting on that position. QQQ was able to get some of the 0 DTEs today. That panned out pretty well. Hopefully that can hedge a little bit of this short position that we have on QQQ because we have a call spread sold. That's going to expire by the end of this week. So we'll see where we're standing when we come back here on Thursday. And then was able to suck a little bit out of those micros today on some of the NASDAQ. And that's helping hedge some of the short positions that we have over here on SPY and QQQ. But last but not least, Nvidia. This was the risk of the week. Ended up selling the 135 calls, bought the 140, collected about $1.72. And just to give you a little bit of a visual, Nvidia has been going on a tear with the overall market. I mean, today we gapped up and then we also kept running to the upside and we closed near the highs. So I ended up getting short near the end of day on this. So I'm hoping I got a pretty good price average relative to where the price of the stock is sitting right now. But I mean, I won't be mad about a little bit of a pullback over here in Nvidia, Gus. So seeing this chart, it was kind of sticking out to me. I had to throw on that contrarian position.
I was going to say the same thing. I mean, it's like just look at this chart, man. That it has to come down. It simply must come down, right? It's just too vertical. And I mean, you get into these situations, and it's essentially the same play I'm making on Alibaba, where you don't need some crazy event to even happen. Just some healthy retraction, which happens as all companies move up. Under typical circumstances, when we talk about stocks taking the stairs up, there is healthy little bounces in retraction as the stock continues to churn upward. So yeah, trying to time up some of those bounces right now is just a strong idea, I think. I also noticed you're up $1 on your Nvidia position. I'm up $2 on Alibaba. Wow. So I'm basically double the trader you are mathematically.
You really didn't have to do that, but you went there.
We're both rich. We can sell these right now, head to McDonald's and get 2 McChickens. Let's do it.
You can't even do 2 McChickens, brother.
Oh, you can. They're like $1. I think they're $1.36. I don't know. Maybe after tax, you might be pushing the envelope.
Oh, you're right. $1.30. Maybe something along those lines. Yeah. You know what? Let's see where this position's sitting at tomorrow. You didn't have to do that. But, if you went there, we'll go there. We'll see how these are sitting Thursday. We'll manage them. But, excuse me. I know that's what the position we have on right.
$2.69?
Thank you. I knew. I was like, that doesn't sound right, because I hit McDonald's the other day, and I got like 2 McChickens or 2 McDoubles. And like a large drink, and it was like $12.
This is shocking. We used to be a proper country, man. Oh my gosh, what? Whoa,
yeah,
man.
Yeah,
is that more expensive than a McDouble? I'm not paying more than a McDouble for a McChicken.
No, a McDouble is more. A McDouble's like $3. It's like $2.90.
They keep quietly hiking these prices. Yeah. It's bullshit. No, a McDouble's $2.69. So yeah, no, they're the same. They're the same price.
Okay, they're the same.
Oh no,
they're the same.
No, it's $3.65.
Okay,
what are we doing?
I was like, no,
boycott this company, y'all. This is ridiculous.
Hey, look, it must be nice to be a big company, because inflation goes up 7%, 8%. You're allowed to raise your prices 200%.
Golly, in high school, I used to roll through McDonald's. I'd get 3 McChickens, a small fry, and a sweet tea, and it was under $5. And that's like, I'm young. That's like 6 years ago. That's
none of us have a unique experience. Literally, 8th grade, McDonald's was built right across the street from our middle school, right after basketball practice. If you could scrounge up $1, 4 quarters, whatever it is. I remember I was getting like 2 chocolate chip cookies, a McDouble, and like a large drink, like a Powerade right after practice.
Yeah. They used to do like 6 cookies for $2 or something crazy like that.
Yeah.
I mean, like, I don't even mean like used to, like, the good old days. I mean, like 2019. Like, this is crazy.
Yeah. I know. Man. We're all talking about it as if this was like 15 years ago.
Well, McDonald's needs to get their act together. You can't be the same price as Chick-fil-A at McDonald's. You can't do it. I'll never go there again. You have to stop. Know your place. Oh my goodness.
No, we'll see how McDonald's plays out. But Baba, we're taking a look at it over here. Baba's a pretty wild swinger. I mean, just looking at the daily chart, it's looking like Baba gaps up a lot and Baba gaps down a lot. So maybe we get a decent gap down for you over here on Baba, but it's been going on a rally again ever since early April.
Yeah, so, all these gaps are so interesting. I mean, if you in a vacuum, if you showed this to somebody, just the candlesticks, and they couldn't see the price and they couldn't see the name, and you said, what does this stock trade at? I don't know about you guys. I would say like $7. Like, this is how like a penny stock moves.
Yeah,
it's so odd the way that this looks and all the gaps that form. But yeah, gaps got to get filled. Streets are saying. So we'll see.
Gaps got to get filled. That's what they're saying out there. So we'll see how these positions pan out. Anything else to add before we wrap up for today, Gus?
Yeah, no, I don't think I have anything else to add. Oh, I'll throw this in. Shout out Nancy Pelosi, because my Vistra Corp position, VST, this thing is printing. Holy cow. I tailed Pelosi and I bought like a month after her. She must have been under 100. Yeah. My cost average is like 105 and it's at 154. So I'm holding the line until Pelosi pulls out. But shout out to the greatest trader of all time, Nancy Pelosi, for putting me on this trade.
Shout out to the GOAT. You're still in that Victoria position. We put that on maybe 2 or 3 weeks ago now.
Yes, that's 3DT. That's 3DT. You know how I roll, Harold?
You rang that one out.
Rang that thing out. Put it through the ringer. I want every dollar I am owed. Damn it. But yeah, I mean, those are both. They're just so far in the money. I'm comfortable letting those ride until Expo for max profit. Rivian is the same situation. 1487 needed over 1050. And then yeah, Victoria's Secret. I needed over 15. It's at 22. That's actually been quite a healthy move out of Victoria's Secret. So pleased with that one.
Love it. We'll see how these pan out. New risks of the week. We have Nvidia and we have Baba. We will be back here on Thursday to recap those trades, manage them, see how the overall week is going. Thanks for taking the time to hang out with us today. And we'll be back here on Thursday at 4:30 Central Time. And we'll catch you guys next time. Peace.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The beauty of Thinkorswim was that we were different. From the name to the front-end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. You know, that's what I do.
Well, he's more public in his mentality.
I'm a believer. I believe that the world is good.
And I know that the world is not good. That questioning yourself and questioning yourself in dialogue with someone you respect is both pleasant and sometimes extremely insightful and useful sometimes.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the tastylive core strategies.
Oh, yeah, it's Tuesday, May 13th, a little bit after 5 p.m. Central Time. The best time, you know what that means. It's time for Tasty Live's evening show, a little podcast, a little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. And they're making us earn our money lately. More on that in just a bit. Before we do so, let's introduce our extra special Tuesday guest. I'm talking, of course, of the global head of macro here at Tasty Live, the one, the only, the incomparable, Ilya Spivak. Ilya, how you doing, my friend?
I love these intros every week. They charge me up for the whole week forward. I'm good. I'm going to start taking some lumps in these markets, but so it goes.
Taking some lumps, yeah. I could see that. I could see that.
Thank God for micro futures and vertical spreads.
Yeah, man. Gotta manage your risk. Stay in the trade long enough.
That's right.
We'll get to that, bro. You know, but you always come in here trying to get straight to work, man. You know, there's a little something I like to do at the beginning of the show. It's called rapport building. You know what I mean? And I don't want to talk about weather. I want to get down to the nitty and the gritty. I want to find out who you are inside. And that's how we do the cold open of the show. You go and
what we were just talking about in the green room.
Yeah, you're a concert.
The summer concert schedule.
Bro, you have a dope life. I'm over rotated. I'm living too much of an old person's life. You're kind of still having some fun with it with the two kids.
I have to do one thing, and live music is that thing. Like that's a thing I can't put down.
I didn't know you did mushrooms.
Not mushrooms, no.
I'm just kidding.
Different kind of genres on my radar. So that wouldn't be the thing of choice. It's a different. I would imagine that would be very scary for the kind of shows I'm going to this summer.
I would also imagine, theoretically. Everybody, that is how you do a cold open. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. But if you want to be part of Bing, this little chat box in the middle of your screen, there's only one place you can do that, and that's heading on over to the evil Google YouTube. Find the Tasty Live channel, subscribe, and then start banging your phalanges and metacarpals and skull against the keyboard. Keep those random-ass characters coming and spoof the Google algorithm into putting us in front of as many people as possible. Ilya, now we get down to business, my friend. Let's put our business socks on and get down to business. The S&P 500 to close the cash session was up 0.75%. The NASDAQ climbed ever higher, up. That's kind of an Ilya-ism there. The NASDAQ up over.
I was appreciating that as it was happening. Like, ooh, nice one.
The NASDAQ up 1.5%. The Dow Jones down 2/3 of 1%. United Health pretty much doing some damage there. And the Russell up 0.5%. Open-ended question to start the show. Ilya Spivak, what say you about risk in the market and where we find ourselves at 5,900 in the S&P?
I think you get price action today that is very difficult to argue with. And it's not because it's an up day. We've had up days, down days, whatever. It's because you don't just have an up day. You have an up day after a piece of data that the markets clearly give you a read on, so you can see cross-market kind of what was generally made of these numbers. And when you look at what the numbers had, sort of how helpfully and sort of encouragingly boring these numbers were. I think you see then the markets, they take about an hour to digest. They spike, then nothing happens. And for about an hour, the markets are kind of thinking about what this means. And as you look through then the intraday, you then see after about an hour, they go, you know what? We're resolved here. And you see the dollar pick a direction, you see stocks pick a direction, and you see how the pricing for Fed policy expectations shifts both in bonds and in Fed funds futures. It's very difficult then to look at the S&P, let's say, and see it break back into that congestion range that was there from early December into the growth scare mid-February and say, this is a market that's spooked. It's obviously not. This is a market that looked at this data and said, well, this could have been April CPI data with all kinds of tariff distortions in it, and it wasn't.
Mm-hmm.
Those distortions were not there. This was normal, in line with a Fed that's looking for maintenance cuts that it's been talking about since at least September of last year, well before the election, never mind all of this latest policy adjusting in a hurry. So you're back to a world where things look like nothing is really fundamentally wrong. Just looking at this with the Fed outlook, with the growth outlook, you do get a weakening of demand pull inflation in the place where the growth concern would be in the core services side. But most critically, I think, when people look at this and they don't see that goods inflation surged, and I think that was reasonable to expect, but they clearly unclench somewhat. The outlook for the Fed actually gets a little bit less dovish, and yet the dollar sells off, as if to say the Fed can go back to a more normal setting here on the basis of this. So if their hands looked like they were tied most recently, they can be untied now. They don't need to be afraid of a tariff inflation spook if this is what the numbers look like.
What does this mean for the way you're thinking about risk? And to give a little bit more meat to that question, there was a period in time where all of the surveys looked bad, but the actual data
and they still do. Let's be clear, they still do.
Yes, people's opinions about the future are one thing. The reality so far about the present is very different. So I'm curious, Ilya, how do you personally, how do you reconcile that here at 5,900, being a guy who's kind of always on the side of price is the king? Narrative is one thing, opinions are another thing, but price ultimately is the one that's telling the realities of the reality versus perception. How do you reconcile where we are?
I think you have to start with the first quarter GDP numbers and say what they had versus what they didn't have. Because what you ultimately have to say is, if people freaked out about the survey data, and they clearly did, I mean, it's not very easy to dispute at all that the breaking point in stocks occurs when you get enough of a linear progression on the PMIs at the start of the year where the market goes, oh, wait a minute, what? This is a dramatic difference between what's happening here and what was happening in the second half of last year. And everybody's screaming tariff risk and just general fiscal policy volatility. But whatever it is, there is a clear retrenchment on economic activity in these surveys. What is this? And then when you look at the first quarter GDP numbers, which are the real kind of growth data, not the survey data, what you find is an interesting duality. On one hand, that negative number probably wouldn't have been a negative number if not for a dramatic surge in imports. You can see it as well in a massive increase in investment, which is just inventory buildup, where all those imports went. So they didn't sell those imports. They went into inventory, and they went into inventory in anticipation of tariffs, because anybody not insane would know as of the beginning of 2025 that a new administration is coming in that wants to do something with tariffs. You don't know what, but you know that whatever it is, if your current cost structure is working for you, you should try to stockpile as much as you can at your current cost structure before you know what to adjust for. So there's obviously this massive front-running effort. And first you start to see it in Chinese PMIs, actually, when you sort of see them start to warm up a little suddenly, because all the demand starts to come in. New orders start to pick up. Then you see it in the U.S. PMIs on the manufacturing side. Then you see it in these GDP numbers clear as day. So that GDP number probably wouldn't have been a negative number were that not a distortion. At the same time, the same data has the weakest consumption growth in nearly 2 years. And consumption is 68.5% of the whole thing in this latest data. So, yeah, the trade stuff matters because the swings are so insane. Imports grew at like 41% annualized. That's insane.
Mm-hmm. But
the overall component that is the external sector in GDP nets out to maybe 4.5% of the whole thing, and consumption is almost 69. So that's the piece that matters. And now you still are left with this idea that, okay, in the first quarter, before all the April Liberation Day, whatever, consumption was already near a 2-year low. Why? What's going on? And you get the sense that if consumers are basically just backing up because of whatever, none of this headline stuff will matter if they continue to back up. And the consumer confidence surveys have been awful. So we're going to see here, I think, this week, a lot of what that piece of it is, because retail sales data is coming up, and then the really sort of early and telling consumer confidence numbers, the ones from the University of Michigan, they give you the first look on Friday. Mm. That survey had 1-year inflation expectations at 6.5%, higher than the COVID high. So this is now going to be very interesting. If consumers have decided to retrench, then what the markets are doing here is just sentiment this way, sentiment that way. But the underlying economy isn't that. And I think that's how you reconcile this. There's the market lens, which maybe has been pulled away to a more kind of headline-driven, more, what did he say now? Now, how is he going to walk it back? What did China say? And sort of those kinds of things. Meanwhile, the underlying economy isn't influenced by those things. They're all way too high frequency to matter. If consumers have really started to retrench here and get defensive, then there's a whole other story here. And as we've talked about, one of just regular business cycle recession, not a crisis, not 2008, not COVID, not 2000, just a regular business cycle shift.
Do you think, how do you factor in the gigantic wealth transfer that occurred sort of post-COVID? Do you think the economy, you're looking at is fundamentally different than the economy that you were looking at in 2019? And in other words, so much money has shifted up that if a smaller percentage of people just maintain their spend, up the income or up the wealth ladder, that actually is enough to sustain the same type of economic activity that we had sort of in a pre-COVID world. How do you account for the shift in wealth that occurred 5 years ago?
I don't think that it is as simple as saying it was a shift of wealth, because there's a couple of things that statement implies that aren't really true.
Okay, what are they?
And it's not that there wasn't the transfer of wealth. I mean, there's absolutely measures you can look at and see it. Okay. So I think the key here, as ever, isn't that I disagree with the premise. It's that to feel out how this works, you need to get your kind of nuance right. And the nuance here is the pie is not fixed. So it's not like there was a piece of pie that and many people had more of it, and then they had to give it up, and then a few people got more pie out of the same whole. The whole did not stay fixed. What happened was there was a massive amount of stimulus. There was a massive amount of monetary easing. The economy grew dramatically. Last year, it was growing at the fastest rate in over a year in the second quarter, or in the second half of the year, rather. Dramatic growth rates. Going back to like rapid COVID reopening type of levels, not at the highs, but going back to reference points back in like 2021, when the economy was racing back to being open. So we've grown the pie a lot. And then the money that growth generated disproportionately distributed. So it's not so much a wealth transfer in my mind as it is an exacerbating of income inequality on paper. Because a lot of what happened was asset prices boomed. And if your assets were if you were mainly receiving money, or your wealth was measured as a measure of your asset holdings versus what you earned in wages, you looked like you disproportionately benefited because asset prices absolutely boomed, because all that money helped to prop up markets. And so it's not so much that what you did was you took consumptive capacity in a one-for-one fixed pie world and moved it. So I don't think you can really say that what's going on here is going to be redeemed because you might get a smaller group motivated to consume while the larger group suffers. I think it's more like we've had a period, maybe over the past year or so, where inflation finally came down such that wages were growing faster than it. And people's purchasing power has had some time to start to catch up. In fits and starts, not evenly, but we're starting to close the gap. It's not nearly happening to the pleasure of the masses and not nearly and for good reason. But the mending is slowly occurring, and I think the concern is that it might get aborted here if either the Fed gets policy wrong and over tightens and doesn't do the maintenance cuts, and inflation expectations fall but nominal rates stay up, so real rates crush the economy, or that consumers are finally starting to kind of pull back and COVID's excesses get spent down and the whole thing just kind of starts to come in and slow, and you get a regular recession because finally all of that cheap money stimulus washes out in terms of its ability to keep feeding what is an economy that has been running on supportive and loose policy for quite a while now.
I don't disagree with what you're saying. It's just at some point we get forced into a decision point where we go, are you going to increase deficits or not? And I think,
of course. And I think the answer here is yes, from what you're seeing.
So then, in a way, I think 2024 was a fairly weak year, but we hit it with sort of this fiscal response. And if our deficits are going to increase, if we hit the same type of scenario in 2025, 2026, the question in my mind has always been, do they do what they've always done? And if they do what they've always... This is the whole
thing. Good. You're absolutely right, by the way. I wholly agree. The question is, does it work if consumers retrench? It only works, and China is the prime example. Look at China. They've been trying to give consumers money for 2.5 years.
Yeah, but the Chinese consumer and the American consumer are two different things.
I agree with you. I agree with you.
That's two different cultures, two different ways of thinking about money and asset accumulation. And I also, there's a part of me, man, that I wonder, we are in a world with negative real interest rates. That means a lot of people were living with negative carry, and they're just on their general lives.
In the pre-COVID years, you mean?
Yes. Okay. And now you're in a world of, positive real rates by 2+%. And if you have negative carry in this, world, you're gonna feel it. You know what I mean? You're gonna feel it pretty quickly. And I think there's a lot of people that have not adjusted their lifestyle because they went 2 decades, bro, with negative carry and being able to get by. And now all of a sudden you got positive real rates at 2%. And I think there's a huge adjustment. You're talking about the corporate level, and I'm with you on that.
No, I'm talking about both, and I agree.
Yeah.
This is the whole thing. Is tariffs this, tariffs that. But if consumption is retrenching, if the growth rate of consumption is retrenching, none of that, all of that is just noise. Because consumption is 68.5% of GDP. If U.S. consumers have decided, to your point, that they live in a world with positive interest rates in real terms, and they can't be so cavalier with their money, and the stimulus well is running dry versus obviously COVID era, that splash out is running out, if not run out already. Corporates have to refinance this year their COVID money. This year and next is when it all generally comes due. It's all give or take 3, 4, 5 year money. And obviously they try to term it out as much as possible. So most of it is to the longer end of that. So they got to roll that over this year and next year. That means that they're not going to be as cavalier about hiring. They're not going to be as cavalier about capital expenditure. So, yes, you can say that all of this policy uncertainty doesn't help. I mean, that's clear. But also you could say, well, they're blaming it on the policy uncertainty. There's probably an element of that as well.
Mm-hmm.
But whether you paint it that way or this, it doesn't really matter. If you get an underlying retrenchment in the economy, at the consumer level, because they are not looking ahead and going, oh, we're getting hired more. Oh, our wages are catching up to inflation at a rate that we like. Oh, there's positive real rates out here. I'm not maxing out the credit card or going to finance a car here. We crazy? No. House prices are still not adjusted, and probably won't be until the Fed really keeps cutting. They're starting to, but we've talked about this before. What it takes stocks a few months to do, it takes housing years to do.
Mm-hmm.
It's a slow market. Transactions take a long time. So all of this, is it because of the tariff uncertainty, or is that just the blame? That's an interesting conversation to have academically. But if consumption is going to keep on the trend that we saw in the first quarter, everything else is whatever.
Let me ask you, I saw Goldman sort of, they had a negative growth projection, like 0.5%. They've changed it. I think they brought it back a positive. I'm curious. When I talked to you, I think it was on Sunday.
Mm-hmm.
It might have been last week, but I think it was on Sunday. I asked you, do you think, in your mind, it seems like recession is coming? Like it's almost like it's more than your base case. It's like I'd put your probabilities from what I hear you talking greater than 50-50. Like I put it at 60 or 70% when I talk to you.
Yes.
How do you think about
and that doesn't mean crisis, by the way.
I'm with you. Yeah. How do you feel about the market seemingly pricing something very different right now?
So I think this is where the kind of shift in the narrative, let's call it mid-February to mid-March versus April, was so important. We've said this before. If you look at the S&P, you can kind of clearly see it's like a season of a show. So, and if you start the season, let's say November of last year, you go, well, this is when you look. We open the season as we learn that there's tariffs coming. Do the markets freak out? No, they clearly do not. From early December until about mid-February, the markets sit there and go, well, let's see what this is, and everything is in a range. Let's see if the handoff is going to be smooth. Let's see if we are going to see policy implemented that's good, bad, ugly, different. Well, let's see how this lands. Even just the handoff of power, which obviously was very rocky the last go-around. And as we see here, there's no big deal until you get to February and those PMIs, and they start to give you a growth scare. When you get to the part of the story that's in April, there's a little pause in between, and the April story is very different. It's more like hair on fire. The U.S. is trying to surgically amputate itself out of the global economic structure, and it is the bedrock of that structure. It's like your house's foundation decided to dig a tunnel and leave. And there's a freak out. But then over time, the markets settle and go, wait, hold on. Even if these guys decide to cut off their nose to spite their face, they're still the only game in town in the near term. There's no alternative. So what does this change, actually? And the president helpfully kind of shows that he's not immune to market discipline. And so you get an unclenching. And now you're basically back to around the place where you made this determination that the growth story was upsetting. So I think we've yet to find out whether what the market is telling us here is that the recession is off the table, or if the market is still operating with a lens of, oh, good, there's no currency or sovereign crisis in the United States. And that's what this is.
Do you see a world where we have a garden variety recession and prices go up in nominal terms? Do you see that world?
I think it's possible depending on what the Fed does. I think if the Fed basically gives everybody cheap money early and everybody decides, oh, this is going to be like a flesh wound. We're not even going to notice this recession. And look, all this money. But I don't think that's likely. I think if you are getting to a place where the consumer is retrenching, that's not easy. And the tricky thing with recessions is they're nonlinear. You never know what a recession might touch off because you can paper over all kinds of things as long as there's growth. If people look at growth and go, you know what, money lost today, no problem, there's more money to make tomorrow because the economy is growing. Fine, whatever. When you start to get negative growth, debt to GDP ratios start to go up because the GDP part of that fraction starts going the wrong way. All of a sudden, people have a harder time floating their debt. All of a sudden, people get more risk averse because maybe there isn't more money to make tomorrow if you lose it today, fast enough anyway. And all of a sudden, things get defensive. And that's where you find holes in the armor. So unclear what happens when you drain the pool there, as it were. And so that makes recessions dangerous in general because you never know what you might kick over. But I do think that there is a recession here that's on the menu, and we still don't know just what kind.
Is there a time? Because I know I'm trying to get to this part of the conversation, which I find fascinating, which is ultimately, do you find it valuable to
know that it's coming?
Do you think it's valuable at all to be focused on or predicting the recession in a world where you could see the potential for a recession, but prices went up nominally? So what the hell did it matter anyway? Talking about whether or not a recession was going to hit or wasn't going to hit.
That's a great question. And yes, I do think it's valuable. It's valuable. Why? It's valuable because you want to know what the market cares about or doesn't care about at a given period of time. This is why I always am harping on the price action matters first. Because in order to shape what you think the market is doing, there's two things that you need. You need an understanding of the variables that you think are at work, and then you need the price action to overlay against those variables and say, well, they care about this seemingly, or they care about that seemingly. So, for example, you get a day like today, market rallies. If you were a watcher of let's say, of macro at the reading mass financial media level, pick your outlet, you would say, oh, well, sure, you got softer CPI. Obviously, the markets reckon that there's rate cuts coming, so the markets rallied. Look, the dollar's sold off. But then if you looked at what really happened, you saw that rate cut expectations actually went the other way and got less dovish. And you go, wait, how does that make any sense? And when you look at it and you then see, wait, the way that this makes sense is because what the markets care about is recession risk. And what these CPI numbers said was that risk isn't great. And that's why you get a parallel. The Fed is not in an emergency, but stocks can rally. Yields at the long end can actually go up meaningfully versus the short end, and the dollar can weaken all at the same time. You need to understand those variables to be able to come to, oh, this is what the market lens is. So when I see the retail sales numbers this week, it won't be about what the Fed will do. It'll be about what the business cycle is. It gives you a way to evaluate the market's reaction function.
After the Fed jacked rates up to 5.25, I think you and I had a couple conversations, and I think you were sort of in credit event watch for the next 12 to 18 months.
Totally.
Now, fast forward a few years, and now, given what's happening in the economy, I think you are on sort of a mild recession watch. I would ask you, Ilya, when do things change? Like, do you stay in the recession watch until it comes, whether that means it's a year or 2 years or 3 years down the line? Or is there a line in the sand where you go, I'm no longer going to be hunting for a recession?
Oh, it's not even that I'm hunting for
bad choice of words, but you get what I'm saying. I'm not in the outlook for it. It's not my base case. I don't have it as a 50 or above a 50% probability. That's a better way to say it. Sorry.
Sure. I mean, let's put it this way. Obviously, when we say recession in this context, what we're saying is growth downturn, because if you go recession with a capital R, formal.
No. I'm just talking two quarters.
Right.
Of growth.
We're not talking, does the worm turn?
I don't care what the NBER says.
The priests at Enberg come out and go, hear ye, hear ye. Yeah. A recession has been declared. It's been over for 2 quarters, but it happened back then. We have carefully read the tea leaves, and we have determined thus now and for all time. We're not saying that. What we're saying is what we need to see or not see is what the business cycle actually does and whether the market cares about it. And what we seem to be seeing on that front is a deceleration to standstill on the surveys over the course of, let's say, the first 4 months of the year. The GDP data giving us clearly a downshift versus where we were last year. Clearly not the downshift that it said at the headline because of all the distortions that we talked about, but nevertheless a growth downshift very apparently. And that this very apparent downshift is coming mainly from the most important part of the equation, which is household consumption. And I don't think you really need to sit there and kind of like look at the tea leaves and go, well, what would it take for this not to be? I don't think you have to think that way. I think you just look at what is and then look at what the price action is doing relative to it. If you now, let's say into the May, June PMI surveys, start to see an upturn, given that you also have a 90-day cliffhanger to stockpile inventories again, because we've just created one with this deal with China, now you go, okay, let's see what the surveys say. Let's see what the consumer confidence numbers say. Does consumer confidence improve? If it improves, then people were freaked out about nothing, and they're starting to kind of come to that. If it doesn't improve, then there's something else going on. One thing that is clearly worrying, if you want to take a barometer of what people think of all of this, Real Clear Politics does a very nice aggregate of polls that's usually fairly time. And the president's approval ratings have been deteriorating over the past week or two. They've been deteriorating over the past several months, but they started to improve a little going into sort of the back half of April, and now they seem to be going the wrong way again over the past week or so. Now, there's not that many polls in there yet. So, and obviously this is a moving target, but what you don't get is the sense that, let's say, starting from the beginning of the year and going into now, that things have become better as far as approval ratings go. No, they've become worse. And so that would kind of line up with consumers being generally unhappy. And if they're generally unhappy, then maybe the story of the second quarter will be very much the story of the first. There's all matter of fuzz around the external sector because we're front-running tariffs, and maybe the deal with China falls apart, maybe it doesn't, blah, blah, blah. But if at the bedrock of it, consumers aren't happy and they keep pulling back, you see what you need to see. I don't think that it pays to try to guess. I think you go with what the data is showing you, and then you see what the market does with that data. And this week is a prime example. If retail sales is weak, but markets don't freak out, well, they're telling you, okay, well, it was weak in April. Of course it was. April was a scary time. Lots of people turned on the news and saw a very red stock ticker at the bottom of their screen. Okay, fine. But if they do freak out, it's a different thing. And then if consumer confidence at the end of the week is again weak and inflation expectations hold up and the markets don't freak out, same thing. So there is an interplay here between what the data is showing you, which you have to understand in order to interpret it, and then what the market does with that. You can't, I don't think, get much insight without both of those pieces.
To pivot just slightly to China, the news that's come out of Switzerland, what's your take? What's your take on the news, the details, or the lack thereof that we've heard out of Switzerland and the current state of trade, of global trade?
I think there's two things here. The first thing is the optics. The second thing is the implication for the business cycle, such as you can kind of divine it here. For China, this is a very welcome lifeline. Their economy has been on life support since before they got off of their COVID lockdowns. It still hasn't picked up steam. It is now in 8 consecutive quarters of economy-wide deflation as of the first quarter. China's economy is in bad shape. And no amount of stimulus that they have done has really moved the needle on any of it because none of it actually creates demand. All of it is inducement to consumers, and consumers are not in a mood to be induced, and neither are businesses. And so they're just not spending. I mean, you look at the spreads between how much money is going into term deposits versus demand deposits, that is money saved versus money there to be spent now, and it's like a 4-to-1 ratio. They're saving, they're not spending. The spread is blown out to levels that we haven't seen since the data begins. So when you look at all of this, you go, okay, this was a very welcome off-ramp for China. They did not need to have a huge shock to their already anemic export sector when their domestic economy is still struggling to find demand. This is good for them. It's not great because it doesn't solve anything or fix anything, but it averts what could have been a serious wallop on top of everything else. For the U.S., it creates another 90-day cliffhanger, and so you probably get more stockpiling. You probably get another surge in imports. Inventories probably grow again. And then you start to wonder whether, if consumers really are retrenching for kind of structural reasons, if that inventory buildup is a bad investment and is going to have to become a disinflationary overhang, downwind. And if this is how you get to a recession, just a pure cyclical, whoops, overcapacity. And then with that comes the idea that this doesn't solve any of the uncertainty, because there is again a cliffhanger. And again, everything hinges on what it seems like is a whim. But what you immediately, I think, learn between the UK deal and this is that the 10% floor, the new 10% floor, seems to be a real thing.
Mm-hmm.
And if that's a real thing, and we're not negotiating that part of it, if that's actually what they want structurally, that is a 5-fold increase in the average U.S. tariff versus the 2% that was the average before all of this. That will hit consumption. The question is to what extent and how digestible it is, and are there other forces that are going to countervail that? Maybe. We don't know. Maybe there's a massive tax cut. And then everybody goes, okay, so things cost more expensive, but I make more, so okay, fine. This is more digestible. I can afford this more. Maybe you get a nice SALT deductions deal, and people in high tax states like I am in California suddenly feel better about, okay, maybe the imports cost more, but I get to reduce my tax take. Maybe on net, I feel okay. So we'll see. But when you get through all of the noise of this, if the 10% thing is really the main takeaway from this entire tariff back and forth, and really this whole thing was about going from an average tariff of 2 to an average tariff of 10, with kind of noodling at the margins on a country-by-country basis, we have what is a much more protectionist setup that is much more inflationary than before and much more growth negative than before in a longer term kind of way.
What do you think the odds are that the discussions between U.S. and China either fall apart or trip into an escalatory position? Do you think that's a real risk, or do you think we're effectively behind this? That's behind us. Both sides want to land the plane, and that we won't see an escalation, even an escalation to de-escalate type situation. As you get close to the end of a deal, sometimes you get an escalate to de-escalate type situation. What do you think the odds are that something like that happens here? Do you think they're high or low?
I think they're low. I think both sides want this over. It seems from the kind of dynamics, and again, over in relative terms. I don't think anybody is going to say there's going to be a grand accord here and the competition between the U.S. and China is over. Not by a long shot. But I think there's an interesting thing about the president. The president is very quick to act. He's not very deliberative. I don't want to say deliberate, because he is very deliberate. But he doesn't deliberate for a long time. But then he also undoes his actions quickly. So he almost is stress testing the policy as he's deploying it. So he'll do something, see a result he doesn't like, and revert with really no, almost as a trader would, with no kind of ego hit or with no need to justify, if only to say, well, we tried it, it didn't work, let's do something else. And so that makes for a less kind of forecastable thing than what is usually normal for the U.S. executive, where there's, let's say, an arc. We want to do X, Y, Z thing. We're going to plan this out over a period of years and roll it out incrementally, but the direction of travel is relatively set. The president does a lot quickly, but then undoes a lot quickly. So it's difficult to handicap, because he might I mean, you just saw it in the press conference the other day where he goes, none of this changes that we might have pharmaceutical tariffs coming. You go, oh, well, that's going to make this much easier. Great. It's like, oh, we have this doesn't change the fentanyl tariffs. Yes, we know it's a 30% tariff, not a 10. Okay, but also for pharmaceuticals and autos and steel, and then you're like, oh, okay. So what can we really know about anything? I think the intent is that both sides want to land at a place that doesn't undermine their own ability to do other things by creating some kind of a crisis. And I think the markets showed both sides. You have an embargo at both ends of the world's most important supply chain. We're going to crash this whole thing into the ditch. So y'all need to wise up. And I think everybody saw that. But do we get more chin checks here? I think almost certainly.
I think I'm trying to be honest with myself. I think when I shared my decision matrix, my assigned probabilities going into this, and I had the highest probability assigned that we would get material progress on trade deals, whatever that meant, with countries ex-China, except China, and I thought the probability was low. I didn't understand, I think, how motivated China would be on their end. That's the part I didn't get. And so I assigned a low probability of us making material progress with China inside this 90-day window. I thought that was going to drag on a lot longer than it did. So I got to be honest, man, I'm pretty surprised that
well, I think a lot of people were. I mean, you look at the market reaction. I think this took a lot of people by surprise.
Yeah, I did not. I had them at 60%. So the fact that they were down to 30, and the fact that we did that within 4 weeks, I did not see that coming, to be very, very honest. I want to ask you, I've got so many topics written down, and normally I never get to cover all of them, but I'm doing my best here to keep this week moving along so I can touch as many different topics with you as possible. Coinbase,
sure.
Up 24% on the close here after the announcement that they're going to join the S&P 500. I want to ask you this question because I know your stance on Bitcoin.
Sure.
So the framing of the question is, how does Ilya Spivak feel about a Bitcoin company's inclusion in the S&P 500 and what that ultimately means for just the acceptance of the business and of the asset class? How does Ilya Spivak feel about that, knowing that I don't think you think it's a real thing? You don't think the asset itself is a real thing?
I don't think that what people at the kind of maximalist end of crypto think it is what it is.
Okay.
But that doesn't mean that it's nothing.
Mm-hmm. Do you think it's valuable? Is it valuable? Is it a valuable asset to the extent that this company should be added to this?
It's a valuable asset to the extent that people find value in it and trade it, and what that does is generate real dollar revenue for a company that is then able to pay people that can then go and eat. In that sense, of course it is. Right? Does it deliver a good or service that is in demand? Yes, clearly. The question for me, when I become skeptical, is it a currency? Is it a rival to fiat currencies? No. Is it a viable kind of way to transact monetarily outside of a government ledger? No, it isn't. We've clearly learned that. So I think the sort of conceit that what this is democratized money and rival money to government money, that conceit, I think, is silly. But the reality that this has become an asset class with its own asset class parameters and with an audience of people that want to engage with that asset class, that's clearly the case. And the making of ETFs, well, first futures, but then ETFs mainly around it, has basically locked it in as essentially a trading vehicle, an investment and trading vehicle, and a financial asset type of a commodity. And so what you have in the earnings of a company providing you basically brokerage services in this asset class is just a reflection of people's desire to engage with the asset class and to pay real legal tender money to do it. So, okay, I mean, why wouldn't it make sense to add this into the S&P 500 if it's a meaningful part of market capitalization by dint of a meaningful part of economic activity? Then it's right where it needs to be.
Fair enough. Are you in any way, to head back to assets and get some of your opinions here on underlyings, are you in any way surprised at bonds and how they've reacted or sort of haven't reacted? They were down another point today. They're up 15 ticks on the reopening. Are you in any way surprised at how bonds have behaved on the long end?
A small part of my spider sense tells me that give it a day or two, and the president comes out with a Truth Social post, something to the extent of, we got a deal done with China, we got a bazillion more deals in the pipeline, the Fed's got to stop screwing around and cut interest rates.
Oh, he already did it. He did that today.
Did he?
Said that today. Yeah,
did he?
Yeah, he did.
Wow.
Actually.
Fantastic. I hadn't seen it, I promise.
He did that today.
Fantastic. Why? Because we're back at that line in the sand. We're back at the place where he intervened the last time the markets freaked out about the reciprocal tariffs. And then we got back here again when he tried to talk about Powell's termination, and he walked that back. So the president does not like interest rates higher. And he doesn't like long-term interest rates higher, apparently.
I don't know why he thinks dropping the Fed funds rate is going to drop long-end rates.
It's not gonna. It's not gonna.
If he leaves them where they are, it will facilitate lower rates, in my opinion, in the long end. But if he drops them, we're going to do it. I think we get the same thing that happens in September. And, after we had this conversation about, why is the president talking so much about rates? And you know what I kind of think it is? I might be overthinking this, but after you and I had the conversation once before, I go, why would he say what he said around the termination thing? And then everyone goes batshit crazy over it. Then he walks it back a week later, and he says, look, if he doesn't cut rates, it won't be the worst thing. And I was like, that's weird. That's really weird. And then you know what I thought? I go, I think somebody explained to him that Jerome Powell could be useful as a scapegoat in this scenario. So in other words, I think everyone wants to hang what happens if we get a weak economy, if we do get a recession. They're going to put it squarely on Donald Trump's shoulders, and they're going to say, "This, you wear this." His political opposition is going to try to do it. People inside of his party are going to try to do it. Media's going to try to do it. And I think at some level, he recognized in that little 1 week period, somebody made it, took him aside, and they go, if he doesn't cut, he'll be a terrific scapegoat. And so now he's like, the too late Jerome Powell. And Powell, every time he gets up and he talks about the uncertainty of tariffs. So it's like both of these guys are pointing big fingers at each other. So whenever
Powell pointed a big one at him. I mean, that press conference, he went full 50 Cent.
So if
he was just
whatever,
like, listen, I'm talking to you. Yes, you.
So in my mind, I see them basically pointing big fingers at each other, sort of preparing for whenever, if we do get a slowdown, that Powell is saying it's not me, it's him, and Trump is laying the groundwork to go, he should have cut him way faster. And I think that's what this back and forth was. I think that's why he went away from talking about firing him to like, you know what? This would be a great fall guy.
I especially like the Shaggy defense on firing him, where he was like, it wasn't me. What? Who said fire? I said fire? When did I say fire?
I didn't say that.
What are you talking about?
His term ends in, what is it? Is it the May 2026? Is that when it is? I think something like that.
And by the way, he gets to stay on the board. It's just his chairmanship.
He won't. He won't though.
I mean,
he won't do that.
It depends. It depends how petty Jay Powell is, and
I don't think he'll do that.
And what the end game here is. I don't think he's very petty, but it would be funny.
It would be funny. He's not that guy, though.
It would be funny, though. I think the real interesting thing here for the bonds is today.
Like this guy is he's like worth $100 million. He's not going to stick around the board just to go, I wouldn't do it that way. That's not what I would have done. I think he's got better stuff to do with his time.
So there are those that are more enlightened. and then there are those that grew up in the 90s hip hop era and go, I'm staying on this board. And I'm giving regular speeches too.
Yeah. In the blackout window. He's just
in the blackout window.
He's doing the Rogan podcast.
Yeah. Like, so Jay, what do you think? Well, I know the current structure is going this way. I'm not a voter this year, but were I a voter?
That's funny.
No, I think the bonds told you today that near-term rate cut expectations haven't changed. They've kind of normalized to what is regular and what the Fed has been saying since September of last year, basically, that they need to maintenance cut. And the long end went, okay, so rates are going to be higher downwind because there is none of this scare. They're going to cut. It's going to be fine. It's going to be smooth. But now we're at that line where the president, as you just said, starts getting uncomfortable. We'll see how he manages to talk rates down here if that's what he wants to do.
Dude, it's very simple. It's like you can jawbone all you want to. I had this great tweet today about, let me see if I can find it real quick and I'll get your reaction. Oh, it was so on the money.
Bungle the stock cuts, by the way, or follow through with this trial balloon that he's been putting out with increasing taxes on the wealthy. That might get the bonds up.
It's not going to happen. But I thought that was I liked that. I was like, yes. Oh my God, yeah.
Those of us that have been looking at corporates finding ways to pay zero at the same time that they are the most valuable companies in the world have for a long time at every end of the political spectrum said, wait, how does this work?
Yeah.
This doesn't seem right.
It's funny how it works too, because they're like slowly inching their way up to the billies. You know, they won't do the wealth tax yet, but so they're like, okay, what if we'll give you another tax bracket between 2.5 million and 5 million in income? Will that work? And then like maybe it'll calm the people down for a little while, but eventually the pitchforks will be out again. They're like, we want 25%.
Yeah, I was just thinking, they're like, well, can we put out the torches if we do this? No? No? Still torches?
No. Still want the money back, huh? Still want the money back. Okay. So trade war on, yields up. Trade war off, yields up. Inflation beat, yields up. Dollar down, yields up. Dollar up, yields down, or yields up. Risk on, yields up. Risk off, yields up. This is why this is not a dip. This is a triple infection of the secular order, cyclical expansion in the U.S. bubble all at once from the highest valuations in the century, already mid-recession, with no intent to ease monetarily, delinquencies at or near highs, credit turning down, rapid earnings, downgrades, and pro-cyclical fiscal austerity, if not by choice, then by imposition. I don't know about the second part, but I thought the first part, I thought the first part was fairly clever, and it's true, man. It almost doesn't matter what happens.
I mean, clever, but wrong. Yields,
no.
Yields are not up since the beginning of the year. They're not.
Yields are not up.
Yields are not
beginning
up
of the year.
Since the beginning of the year.
Where
is that low that you see on your screen there, marked with the red flag there?
That's after technically.
That's the beginning of 2025.
I'm just if you're being precise, this was where I would have to go to the continuous contract actually.
Yeah, but my point is yields have not meaningfully rallied.
Sure.
Nothing has happened. We had a growth scare whereby yields went down. Then we had a sovereign scare whereby yields went up. We are currently digesting the sovereign scare basically at the levels where it petered out. So to say that nothing has happened but yields have been relentlessly moving up is just not true. They haven't been relentlessly moving up. Look at a weekly chart to kind of smooth out some of this. You can very clearly see it. Yields have ultimately had a growth scare and a sovereign scare and are nowhere for the most part relative to where they started the year, because the whole thing is shrouded in uncertainty and nobody knows, which is exactly what the Fed's been saying. We don't know. We know how this has looked historically. We don't know how it's going to look now, and we have enough of a healthy economy on paper in the hard data to be able to sit and wait to find out. And the yields are validating it.
I got a little bit long bonds, and I'm a
little bit long bonds too.
I was short at 117 just for I was short at 117, and then at 114 I got flat. I'm flat, and now I kind of like the idea that now that recession has moved out of the baseline for most people, it's gone from the 50-50 down to like 30-40% where it normally hangs out. I sort of like the idea, and as there's going to be more trade clarity, I kind of like the idea of playing the long bonds now when they shouldn't work right now. And so I like the risk reward here being down at 113, but I could very easily see sort of the market's growth and inflation expectations starting to turn around here and getting super aggressive to the upside and bonds yield spiking. I could totally see that.
Here's what I'm seeing.
Real quick to finish the point. I'm not going outright long the bonds. Sometimes if I like to trade that way with a little bit more leverage, a little bit of bang for the buck. I'm just doing long call spreads here. Go ahead, Ola.
No, I'm doing the same thing. And the reason I'm doing it, and I think you can kind of see it in the bonds here, is I completely agree. There is a risk-reward thing here. And where that risk-reward thing comes from is, again, you can see the episodes of the show. You come into the beginning of the year, you go, okay, the Fed has told you incessantly, I am cutting rates in 2025. I am cutting them in 2026. They told you that very clearly in September. Then they moderated from a crazy amount of easing to what looked like just maintenance and normal. In December, they reiterated it in March. Look at what the bonds have done. Since the beginning of the year up through that spike before Liberation Day, bonds are going higher. They are in an orderly stair-step up move. Because the Fed is about to cut this year. That's it. It's a very straightforward thing. The dollar is weakening. at the same time. It's all very clear cut, very orderly. Gold is rallying through this time. It's classic. When you get Liberation Day, you get this, oh my God, the U.S. is trying to extricate the treasury bond as the world's risk-free asset and the dollar as its currency of commercial exchange, and they're doing it themselves. Why would they do this? This is crazy. And the bond and stocks and the dollar all fall at the same time. Where are we now? We are at exactly the place where the market decided was the value point for that risk. We are where that risk was priced in, because that's where it stopped. So if now then you have the same reset in stocks, which you do, then the question is, okay, so back to growth. What world are we in? Maintenance cuts world, which is why you get inflation that was a little cooler today. The Fed policy odds actually get less dovish and the dollar sells off. Even as yields come up. It's very tempting to say weak inflation, dollar sells off, surely yields are down because it's losing yield appeal. No, yields are up. So this is why it's so important not to have a mental model of macro is the machine. You press the red button, the red piece of paper comes out of the other end. It's not linear and it's not static. It's chess on a liquid surface. It changes all the time. That's why watching the price action is so important. The price action will tell you which part of the multiverse you're in, as it were.
Chess on a liquid surface. Where'd you get that?
I made it up. Not today.
Good. I like it. Oh, you know what? Here's the last one. Last one of the day, and we have enough time. How much time have you done thinking about the executive order from the administration on pharmaceutical drugs, the most favored nations clause? Did you see that?
I did see it. I've been thinking about it kind of tangentially. I don't think I have enough information to kind of have deep thoughts about it, but I have this sort of, my first impressions are, number one, you can't do anything this way because that's not where the price differences come from. This is sort of as crude as the reciprocal tariffs thing, and we've had to walk that back. The reason Americans pay so much more, and again, he's identified the problem correctly. There is a problem. The problem is that Americans pay ridiculous amounts for the same drugs versus what is paid elsewhere from the same manufacturers for the same drugs. But what you're telling then drug companies is, never mind the vast differences in the way that you are compensated in this jurisdiction or that jurisdiction, you have to eat it with us. The problem isn't that the drug companies are charging this willy-nilly in the exact same system because they don't like our flag or our anthem or just generally harbor a grudge against Americans. These are very different medical systems that are comped in very different ways. So it doesn't seem like the solution fits the issue. And secondly, when you start to throw around numbers like, we're going to bring drug prices down by 30 to 50%, it's like, well, the delta between that is very, very big. What's the plan? The plan is we're going to bring it down by 70, 80, 90, maybe more percent once you do the math. It's sort of a paraphrase quote. What is maybe more than, so like 100%? What math? What are we saying? So it's unclear what it is that we're doing, but in approaching the problem from this perspective, saying we are going to bully pharmaceutical companies into lowering prices without changing anything about the underlying environment, it feels like it's the kind of thing that a communist country might do, and it's not going to work for the same reasons. Command economies are inefficient and ultimately fail.
I agree. Unfortunately, I don't think
The problem is correct. He's identifying the correct issue.
For different reasons. I actually think it's going to get blocked in court.
Maybe.
I don't think he's able to do this from the executive, and I think it'll end up getting blocked in court. So they'll have to try to sneak this into that big, beautiful bill that they're trying to get passed.
Maybe.
So I think it's really interesting. I thought it was interesting that a lot of the drug companies rallied yesterday. I'm sort of scratching my head, like, why would they be rallying? At first, I thought it was the mechanism, the way this would work. If, let's say, Americans are paying this much and some other countries paying this much, well, you're going to maybe discount the Americans' price a little bit and then just jack up the other country's price to be above the U.S. It doesn't necessarily mean that America gets to pay that rock bottom price of another nation. You just need to change the pricing structure. So that was my first read through, and I think what the market was doing yesterday, it was just reading through that this was likely going to get blocked in court, that there wasn't a big reason to freak out about this on the price side. And that's kind of where I landed on day two after thinking about it.
That makes sense.
All right, Ilya, let's do it this way, man. Let's just we used to do this. I haven't done it in a while with you. Just give me 1, 2, or 3 sort of either price extremes or high confidence sort of plays from your point of view into the next Tuesday that we talk for the next
I think
week.
one of the most interesting things on the board here is the U.S. dollar and its refusal to correct higher in a lasting way. It's mostly held on to its losses from what was that freak out in April. Whereas stocks have obviously done the full round trip, bonds have almost done the full round trip. The dollar is not doing that here, and I think especially when you look at the growthy type of crosses, like the Aussie has stormed back, and that's one I am long, and I think you might be looking at the start of a breakout there to the top side. I think if you wanted to find value. The British pound is one that seemed to undo its attempted breakdown and now looks like it might be coiling up for a rally. The dollar does not seem to be able to find a lifeline through any of this. In fact, today it sells off not because inflation is weak, but despite the fact that the inflation numbers give you higher yields and a less dovish Fed outlook. That isn't to then misread the dollar outcome as a consequence of dovish repositioning would be a mistake. And because that's a mistake, because there was no dovish repositioning, but the dollar still sold off, that tells you that it's an asset with a lot of underlying weakness in it. Because frankly, it shouldn't have sold off like this today, given what yields did and what policy expectations did. Nevertheless, here we are. So I'm looking so I'm already a buyer of the pound again. I've been holding the Aussie. The yen has not been as responsive because yields went up, but I'm still holding that long. And I'm down a little bit there, but it hasn't crossed any red lines. And I want to be a buyer of the euro. I think that's probably the one that's the most on discount relative to kind of how promising the story might be, especially if they spend a bunch on defense next year and the ECB can't cut because they've created inflation with that spending. So I think the euro looks really attractive. It just needs to confirm a little, and the pound maybe is already confirming. So that looks very appealing. I also think gold held its range today, despite everything.
Yeah.
And if you're gonna take a punt at what gold does at the bottom of a range here, the risk reward is bounces, given what the dollar did. Now, I'm talking my book here. I'm already a little
why
bit
not
long
why
from
not
the
buy
last time
silver?
we tested the bottom
Why
of
not
this
buy
range.
silver? If you got a rally in gold here, do you not think silver would come with it and with higher beta?
Maybe, but I don't buy the cleanliness in silver because silver has this overhang of risk sentiment in it. It's more sensitive to things that happen in stocks than gold is.
I agree, so I 100% agree. The way I've seen gold is gold got a monetary premium, silver got a growth discount.
Yes.
And I think so in some way I thought the monetary premium would and did come out of gold a little bit less than I thought, quite frankly.
Right.
And we haven't seen
the dollar
growth
too
discount
less than you might think
come back into silver. And that's why I think if you actually get a rally in gold, depending on why, I suppose, but if it's technical in nature without much of the narrative changing, without risks necessarily changing, I still think silver, I'm going to go down swinging on the silver trade, but I still think silver is a good bet here.
I mean, maybe it is. What I want is specifically the monetary story, because what I'm looking at here is a dollar that doesn't want to rally even when you might think it should on the monetary dynamics, and the market seemingly saying, yeah, the Fed is likely to delay, but that also means that they're likely to do stuff versus be paralyzed. So, okay, if that's the read, and that's why the dollar is what it is today, and so are yields, then gold's going to go higher, because gold is going to respond to the monetary element of the central bank is easing.
I like to make you're very pragmatic person. You take a lot of time to think through things, and I like to force you into binary degenerate trader gambler type questions.
I mean, in so much as I'm trading all the time, I have to be ready for those questions.
You're gonna hate this one.
Okay.
Give me the high price of Bitcoin. Give me the high price of Bitcoin for 2025.
The high price for Bitcoin. Well, let's see. Let me consult my tea leaves here.
The high so far is like 109.
The high so far is like 110 on the futures. On BTC futures, full disclosure, continuous contract, which is not market prices. It's a blended thing. Is 110, 150. So we're entering that kind of area now, the range top from December 107 and change to 110 and change. If I had to give you a high price for the year, first of all, I would think it's higher because I think the dollar keeps weakening. I think if you ended up at, let's say, 125, 130, it would not surprise me.
125, 130, you say?
Yeah.
I think I'm going to say 175. Well, I'm going to say 165.
Okay.
I think it's going to make a little bit of a run this year. I think we're in this weird accumulation phase, and nobody's talking about it. I don't get it. And if nobody's talking about it now,
you've seen is anything having to do with Bitcoin whatsoever. I think it's a risk-on rally. I think it's the NASDAQ times 2.
Sure. I don't argue that.
Yeah.
I think it can win in two ways. I think it wins on the left tail because you're going to get a response to the left tail. You get a recession or some credit event, you have to respond, and that is going to catalyze Bitcoin. And I think it wins on the right tail through just a risk-on sentiment. So I think 160, 165 is in the cards.
I think the reason that my kind of top of the range is, let's say, 135. I think that's like you're going to have a really hard time going above that, is because I think it is a risk proxy ultimately. And if you do get the left tail, you do get the recession outcome, it sells off with everything. Correlations go to 1, stocks go down, it goes down. I don't think it emerges as a haven in that environment.
I think it really just depends on what people think of the dollar. And I think they're going to think it's toilet paper. I think any bump in the road and it's toilet paper.
I think it's been toilet paper. I'm obviously short, but I don't think it's toilet paper longer term. I think it's very much Fed is going to cut, and as soon as they do cut, because when they cut, they're cutting for a reason. I think when they do cut, that might be the bottom in the dollar right there. And the dollar, in fact, might bottom a little bit ahead because we go back into the go to cash mode. And we just learned in April that the cash is still good. We just learned in April that sovereign risk in the U.S. is not a real thing because there is no alternative, at least in the near term. It's not a imminent thing. It's a write books about it. We'll wait a few more decades. Who knows how empires behave in their twilight type of thing.
You just dropped a jewel at the end of this episode. I really like the idea that the next cut could be the bottom of the dollar. I have to think about that a lot more. Ilya Spivak, if the people want more from you, tell them where they can go.
As ever, I'm all over the PM part of Tasty Live programming. We start with overtime right after.
Oh yeah, you do like 3 hours straight.
All over every.
I just realized you do overtime, then you do macro, then maybe you get like a little half-hour break, then you come in.
Then we do this. I get a half-hour break, then we do this. I love it.
Good man.
I love it. So I'm all over the PM part of the network. So all kinds of after the close, reading the macro tea leaves type of stuff. I'm all over that all week long. Overtime, then macro, money, and once a week the privilege of this show. I'm also on Futures Power Hour Mondays and Fridays. You and I talk to Tom on Sundays for First Call. I'm writing for the News and Insights portion of tastylive.com, where all of my macro stuff is in written versus video form. And I'm commenting at Ilya Spivak on formerly Twitter and on Blue Sky because this macro is for everybody.
You going to read Jake Tapper's new book, Original Sin?
It's not high on my list.
President Biden's decline, its cover-up, and his disastrous choice to run again.
I mean, eventually, probably. I've never read anything that Jake Tapper has written, but I like him as a journalist generally. I mean,
wow, that's such a joke of a book. How can the guy sat as the lead anchor on CNN and told everybody a narrative that was not true. Now he's writing a book to uncover how he was lied to and how the media was lied to by this inner circle of the White House. There's zero accountability in that. This guy is the lead anchor at CNN. He went to Dartmouth. I figured it out from my couch that this individual was not super with it. And this guy had at least one interview with him in 2022 in the map room of the United States, sat right across from him. You didn't figure it out, man? Give me a break. You want me to believe
it's why I'm saying this is not the kind of book that would be high on my list. I am more so interested, and I'm looking forward to reading Ezra Klein's book, Abundance, because it seems to be starting to make the rounds as a kind of.
I would read that.
As a kind of rallying cry for something that looks like it might be constructive centrism. And so I'm interested in suddenly there being this kind of zeitgeisty push off extremes and toward what is like a centrist view of, okay, we know what the problems are. Nobody's really offering anything real or substantive to fix them. Just more chaos of this flavor or that. Let's have a real conversation.
Yeah.
it's in my queue. I'm curious about that one.
I don't agree with a lot. I don't agree with everything Ezra Klein says, but I believe it comes from a good space. He's constructively critical about all sides. And I like anybody who's going to say, hey, this is what's not working, and be 100% honest about it and call balls and strikes. I like
one of the few political shows I watch.
Jake Tapper is trying to wash his hands of his own sins. So I think it's funny he's calling it original sin, because this book is all about washing his hands of what he did for the last 4 years and trying to paint a different picture, kind of memory hole, what the hell, how he participated in that whole nonsense.
This is why I generally don't watch. I don't consume my news largely from sort of regular watching of television news networks, with the exception of I watch Bill Maher's show religiously.
Do you?
Because I think that there's a lot of valuable conversation that happens there. And I read The Economist religiously, because I think you get a lot of straight brass tacks reading of politics as it pertains to actual policy reality.
Do you like Bill Maher's podcast? Or just
I haven't watched it as much because it's very long form and just takes a tremendous amount of time.
Mm-hmm.
Some of it.
All right, man. Well, it's always a pleasure. I appreciate you stopping by and doing another 90 minutes after all the content you did earlier today. It's always a pleasure, my friend. You're a gentleman and a scholar. And I'll see you back here on Sunday, man. For all of you out there, do me a favor. On your way out, hit the like button, subscribe to the channel. Make sure you go follow Ilya. If you haven't already, check out his blogs on tastylive.com. Follow me if you want, at Victor Jones. The O and Jones is 0, because I like to be difficult. I'll see you back here tomorrow. Somebody said, read? Question mark. I'll see you back here tomorrow. Same time, same place, same great network, only on Tasty Live. Peace.
Peace.